All right, good morning everyone. Hope everyone's well. I've just moved my mic, just let me know if it's too quiet and I can adjust it back. Hope everyone's doing well. My name's Tim Fairweather. I'll be hosting today's price action trade room, at least in the morning. G'day Rory, g'day Edwards. We've got John, we've got Good Things. Thanks for joining on. We've got a bit of an all-star cast today. We've got three of us on, so we've got myself up until 11:30, and then we've got Dr. Brooks for a couple of hours after that, and then Brad Wolf to take us home. G'day Rose, how's it going? So yesterday, how did we do? Let us know where you entered, where you got out, what trades work, what didn't. If you got any questions. Yesterday's, classic triangle day. If you've been on one of my streams before, I like to draw the triangle. It probably seems a bit immature and unnecessary, but it really does help me take trades, get in, get out, and if I make a mistake, I've got a chance to rectify it. Triangle in the open, so nothing to do. Okay, so if you're sitting there in the morning, and this is my read, of course, every presenter is going to be slightly different, every trader is going to be slightly different, but for me, at the moment, there's nothing for me to do. If I look back at the chart, what's the most obvious thing on the chart? Well, this. So huge sell-off, many legs down, and a number of support layers all the way up. Okay, and if you start drawing lines, you'll end up drawing about 50 of them, and sometimes the market goes and tests all of them. And that was pretty much what happened the day before yesterday. If you are familiar with Al's encyclopedia, or you've heard Al on the trading room before, he'll say yesterday was a sell climax day. Expect a couple of hours of sideways to up trading. So when we came into the day before, that was the expectation. But this was pretty strong down and this was pretty strong up. And then we say big down, big up. What do we get? Confusion. And by confusion, what often results is a triangle. So a triangle happens when we don't take out any one stops. So you've got traders that are short up here, and you've got traders that are long from any of these down here. Never took out a swing low. And because no one stops have been hunted yet, people think it's short, people think it's long, and the best way to trade it is to scalp. But eventually, a higher time frame comes in and the market's got to go do something. It can't stay in there. So I was sitting there flat, and then I was lucky this was, as this was shooting up, I usually wouldn't buy as it's forming in a tight trading range, but I thought it was okay. And that was pretty much the only trade I took in the morning. I tried to get a pullback, and it basically went up straight to the target. It was basically all I did yesterday. And trading's not usually like that for me. So that was a bit of a surprise. And I was thinking of scaling in a little bit lower, and then I didn't like 19. But if you were flat, 19 was a good place to get in. I like to enter on breakout points, and so there was a nice little buy in there. That was very quick, 5 or so points. And then this is disappointing, so anyone who's still long is looking to kind of, either scale in and get out, or they might just decide they don't want to be long anymore and wait for the next trade. And then if you're flat and you see this, what I would usually do is look for a trade back to the moving average. So when people are confused, so strong bull spike, big bear bars, we usually go back to the moving average and go sideways for a few bars. That's usually what happens. Here we were up strongly, then down strongly, back to the moving average, 3 or 4 bars. So we went up, and so the next trade is down, and it usually has to be a limit order back to the moving average. Trading range open, spike out, but never took out any of the bear stops up here. And that was the problem. That's where the stops needed to be hit, but they weren't hit. So those bears never really got out. You could say some traders put their stops there, but in a trading range, I just look at the extreme point and see if we're broken out, and we never did. So where does price go? We start going back down towards the stop's going to be down the bottom. So I didn't take this trade in here. It might have been difficult to hold through 26 to 30. It's usually the case. It's got that kind of wedge shape, 1 pause, 2 pause, 3. And if you're flat looking for a reason to buy, you often don't get a good buy signal until it's too close. So here you got a bull bar, you got a bull doji, not great. And then we broke to a new low of the day. and then instant reversal. And if you're a beginner, you'll take these ones all the time. But if you're a little bit more experienced, you won't switch from sell the close to buy the close necessarily. You usually wait for a pullback and just to see that this is finished. There's no more legs down. And that went back up to the open. So that's the other common occurrence on the trading range day. We spend a lot of time around the open. You see here where I've got this triangle, I've also got a line at that apex as I see it. So that can be another way to trade, and you'll see for the rest of the day, back and forth to the apex provides a number of trades. So you can be buying below that bull spike, scaling in below the day. It worked. Traders who bought the moving average here actually got stuck. So I switched that from blue to red, and then you could trade back to it. So then you can get long, betting that on a trading range day, those traders will get out. And then the same thing applies here. Bears who are selling the moving average got stuck, and then it switches from resistance to support, and you can sell back to it. And then it gets too small for human traders, computers take over, and we squeeze into it. So I haven't had anyone tell me which trades they took. So I think buying 11, buying 12, 16 is okay. It's high in a trading range day, so I'll put an orange on that one. You just got to be careful to get out. Trading range day, buying a breakout point is good. And then 23, for me, the buy is one tick above the high. So that's not a buy signal. And if you ever see a high 2 like that, which fails, then for me, this is a good sell here. That's the sell I want to take. So failed high 2, we've had a couple of those last week, a couple of those a week before. You get that buy signal where you want it to be, you know, I call it the outlook special, high 2 at the moving average, and then it instantly fails, goes below it. Those traders can't scale in, they've got to get out, and that provides some momentum to go down and test their stops. On the way down, look, not very clear. I think the sells were up here, and you know, you hold it to the bottom of the bull spike, testing for your new low of the day. Wouldn't really sell anything in there. 36 was okay. 37 is okay, but the problem with 37 is you're buying at the moving average, so I'll get that. I'll make that a yellow. Better to wait and wait for the bear bar to fail, and then once that bear bar starts failing, I think the buy's on 39, and you're running it up to, if you can get up to any of the areas before. And then this is tough in here. You know, you can buy, sell in this big box, and you'll probably be disappointed. You'll be sitting there, it'll be very difficult to take a couple of points, and you get frustrated and say, hey, I'll come back tomorrow. So I'll get rid of those. Any questions about that? Just let me know. Very easy in hindsight when you're looking at the chart at the end of the day. Totally different thing when you're looking at it form, and then totally different thing to actually put a trade on. So you see I've got a number of lines on this chart. I've got 3 moving averages. I've got the 20 bar moving average on the 5 minute. I've got the hourly 20, and I've also got the daily 20. Okay, and you can see all of them squeezing in, and we're hovering between these 3. So wouldn't be surprised if we do a little bit more action like that today. We've got no news today, but we've got a fair bit of news Wednesday, Thursday, Friday. So, you know, will the market squeeze into an even tighter triangle today? I hope not. I don't think it's going to, because this range is too small really for a day. So higher time frame. We've got high of last month there. Nearly came down to test it. You could look at it on the daily. So a little bit of a gap on the monthly chart, so still good for bulls. Very strong, strong spike, pause, another strong spike. So can bulls get another leg up? Well, it makes sense. There's nothing to sell on the monthly chart yet. So there's a breakout gap with January of 2022, or micro channel, so buyers below bars. Weekly chart has just been this crazy tight channel, hugging the moving average and call it a small pullback bull trend. And there's been no sell signals that have triggered. So we've had sell signal, potential sell signal, and then we've had an inside bar, both bears, but we never went below a bear bar. And that means the first time we go below a bear bar, there's probably going to be buyers. So we can put a little box there. If that's going to be the low, I'd say more likely buyers below. A lot of these support and resistance areas probably a little bit far away for us to talk about today, but at least on the higher time frame, I think the closest magnet would be the high of last month. But even so, at the moment, we're about 30 or 40 points. So if we're going to go there, probably tomorrow or later in the week with some news. So Globex chart, if we take away the last bear leg, small pullback bull trend, and you can see all the best buys were bear bars, pretty much. They were the easiest to hold. They instantly went into profit. And that's common in small pullback bull trends. So what a lot of traders will do is, because in a channel, you're taking profits at new highs, or you're adding on small at new highs, and you're looking to add the rest of your position on lower. Moving average, below something, get back to something that failed, breakout points. You're looking for a reason to add on, and what happens is just before you get to that point, it usually reverses. And you can see here, as price gets to a bear bar, here we go, we've got a bear bar that fails, we get up, and as we come back to that bear bar, just got in there, just got in. And it's been doing that all the way up, and then at some point this trend's exhausted, it's reached targets, and a trend line needs to break. So we break a trend line, and then what usually happens, I've just drawn in these two lines up here, it didn't matter which one you used, as soon as you break a faster trend line, market will usually come back and test that breakout point, which it did on that bar. So we broke, tested, and then came back down. And I said a couple of weeks ago that I thought this area, this small area here would be a magnet. And then on the next session, I thought, well, this is now a tight trading range. We'll probably come back there. So when we get back to this area, you think, okay, well, we've come back to the bottom of a trading range. We'll probably go a bit sideways here. But the traders bought it. Straight back up, straight above the moving average. So still buying pressure. You might have more bulls looking to buy within the range of this bar. Let's just change that up. You've essentially got a high 2, but we didn't trigger. So we haven't yet gone above that bull bar. But we've got magnets above that bull bar and above that bear bar. So would anyone have sold this bar? Well, typically, I think a stronger trader looking at a very fast trend, very strong trend, the first bar or adverse bar that closes below that moving average is usually a buy signal, unless there's some other context. So here's another example. The first time it closed below the moving average became a buy zone. And it works the other way. You've got a trend down, bull bars closing above the moving average becomes a sell area. So no surprise there. The question is, if I'm a bull, where do I buy and what's my expectation to go up? Well, on the Globex, I think it's a bit clearer on the Globex anyway. So if I stopped there, what I'm saying is swing target of a new high, maybe. One-to-one target testing the high close of those bull bars. That's reasonable, about 5,300, 5,313. Other traders will look at the high close there. So if we take the highest close, let's say, okay, well, what's a swing up there? So they might be looking to buy somewhere 52.41, 52.29, maybe somewhere around there. But even if you don't get fancy with the targets, you can just put your fib on that bull bar and say, well, I think somewhere in that range is probably a good buy signal, at least on the daily. Globex chart, outside bear bar, inside bar. So we gapped up to sell off, and then you can see there's a large gap here as well. So the moment that bar closed, those bears were basically stuck. So I suspect if we pull back in here, we'll get more up. I have to take a look. Thanks to you for the question. I'll come back to that shortly. Much appreciated. So I'll get rid of those trend lines. We don't need those. We had a strong bull spike, and then we went below it. That can often set up a measured move in the other direction. Let's just turn that into a 2, which will put us somewhere down here. I'll put that down there at least on 60-minute failed spike. That's a bit of a problem for the bulls. Very strong spike, breakout, failed, and then we're just continuing in this channel all the way down. So I think that's a possible if we go down there. However, we've now got a strong bull spike here, so we might just go sideways. Triangle on the hourly, we're between the two moving averages. I wouldn't want to be short or long at the moment here. I think this is just too tight. But I think from a price action perspective, that's the last thing on the chart. So then it makes me think that, okay, well, that was the last move, and potentially that's where we should go. But we could start that here. We could also start it here. We could also start it down there. So I think we'll wait for a signal to direct us on that. So what I'll do here, so it's not so large, I'll put that there. I'll get rid of that. And then I'll get rid of those. That's okay. I can move that out of the way. Keep the chart nice and clean. Get rid of that. Hooyah. Okay, so you sold below 24. Let's have a look. So selling below 24, yep. So did you sell on the stop? Like, did you sell the close, sell on a tick below it, sold the market? Targeting the center of the opening triangle, hit on 26. Yeah, look, that's one of my favorite trades. Tight trading range, and then we have a very rapid acceleration out of it, and limit order traders just cannot get in here. They get in on this bar, which is not great. They've got 14, which is an inside bar and a doji, and then 15. It's a bit stressful if you're a limit order trader there. Not easy to get in. And then usually we go back to the center of that triangle. So the advantage of that one is if you've got another size to scale in, I think that's a really high probability trade. All the bulls have just failed up here, so you're selling where they're getting out. And usually it's something like this, where you have one bar that goes in your favor here, then you get a little bit of a pullback above it, which is bulls getting out, and then goes back down. And if you can hold, if the bulls succeed, you just get a chance to get back out there. So I think that's a really good trade. Nice trade. Tim, what indicators are you using? Just a 20 bar EMA. So my daily is set to the 24-hour, so the RTH. Oh yeah, market order. Yeah, and I think that's correct. I think in a trading range, market orders, limit orders, the best to use. You generally, if you get a good stop entry in a trading range, like you've really just got to be a bit suspicious. Yes, they work. Can you often get a better price? Yep. Even in here, you're buying above 66, sure, but you could also wait for it to come below. You could have bought below 67, and you could have bought the 66 close or high for the next 25 minutes before that next leg went up. So, yeah, you've got to be suspicious. How do you avoid, okay, Alex, how do you avoid taking 23? 23. I'll tell you what, let's screenshot that one. It's a good question because we've got a few of those. So I'm just going to hold that one. Just give me 1 second and I'll put them up on the screen. Here we go, new Google slide. Let's go blank. Beautiful. Okay, let's get that. Let's get that. See if I can get one more on here. Failed high 2. Can you see that? I think I'm sharing this monitor, so that should be okay. Let's take a look. So what are the similarities and differences between these? To me, they're all failed high 2s. Another way to look at it is an attempt from the bulls to do something strong that just didn't work out. So it either failed instantly or it failed within 5 minutes. And then that way you basically get back out where you got in, or for, very small loss or small profit. And then you're basically sitting on the sidelines to wait for the next move. So that was yesterday's. So spike up, pause, second leg, and the clue for me here was that this close was not above the high. That said to me, at the close of that bar, bulls ain't that confident. And that's okay, it's a channel. That's fine, you expect that. But then part 2 is very strong pullback. So this is less like a very strong spike, more like a trading range or a very broad channel. And I've got to be really careful buying high. High usually means too far away from the moving average. And then when 23 sets up, so I've already had a couple of suspicious things going on. Because I was already in that trade, and then I got out and I saw that and I was really glad I was out, by the time 23 sets up, I'm not looking to buy again. And so I think one of the best exercises to do is, if you're flat, imagine you're in that trade, something just happened, and then see if you're going to add on. If you were long and you saw this, would you add on the close of 23? I wouldn't. Outside bar, little tail, didn't go much below the moving average. This just doesn't look that strong yet. I prefer to wait and scale in higher. But if you are going to enter that trade, the order is above that high, at least in my view, for specifically this reason, that if it's going to take off, it needs to trigger those bulls. If we have a look at this one here, so same again, this last leg looks like a trading range. Deep pullback, that's okay. Reasonable buy signal 38, but see how it didn't go a tick above 39. I know it's not going to be exactly a tick, but I think you'll get the point there. Didn't trade above that, reversed. Okay, that's interesting. Usually when high 1s and high 2s set up in strong bull trends, we tick gap up. Traders are just, gagging to get into that trade. Then we've got 40, 41, tail above, and then 42 is forcing me to do the same thing. So same thing. For me, the order is above it if I'm going to take it. Otherwise, I'm going to wait. So if you got in on 41, you see 42, that's great. You see 43, you think, that's not great. Possible failed breakout. And in a strong trend, you don't usually get a chance to get the best order that many times. So to get, for a trade to take off, come right back to your entry is suspicious. So you get out. If you don't get out there, well, you need to get out on 44. And then by the time you see 45, well, you're waiting for a pullback to get short, at least in my book. Does that make sense? And then similar on this one. Strong bull bar, bad follow through. High 1, bad follow through. Another bull bar, bad follow through. Tail, and then we didn't go one tick above it. So it's giving you signs that no one wants to buy high. Everyone wants to buy low. Now we've got consecutive bear bars back at the moving average. So your premise of buying high in that channel, in that breakout's gone. It's a channel, you're looking for a high 1, and you never got it. You got 2 dojis and then collapse. And then similar setup here, you got a high 2, but it was below the moving average. So there was something wrong with it. So I can screenshot that. That's what I'll do. I'll screenshot it. Yeah, does that help? I know, just bear in mind, like, I'm doing it with complete hindsight with all the charts available, but if you can train that sensitivity, particularly if you have not entered in that breakout and you're waiting to trade that second leg, then you're usually looking to find entry a bit lower and you're watching to see that. Let's just get rid of that one. Okay, Claire, I think of that as a head and shoulders. The right shoulder couldn't make a new high, so exit. Yeah, whatever's going to work for you when you see it. And I think particularly if you've got context for a trading range at the beginning, then you've got to be a little bit suspicious of sudden fantastic breakouts. Okay, so we've got the ETH chart here. Let's get some Globex highs and lows. Globex low down there with Globex high up here. The market's about, what's that, 52.71 here. Let's have a look. Globex high. Those. Turn that off. Okay, so we're basically up at yesterday's high, so it looks like we're going to be a gap up for the open in a couple of minutes. We're about there. All high twos are not created equal. Yeah, that's basically right. But it is a really high probability trade, and it's one I think you've got to have in your repertoire, high twos and low twos, because even if you're trading with limit orders, at least in my view, most traders, when they see it, will trade that with a stop anyway. So it's usually a pretty clean entry. The alternative is to sit through this, I'm not really sure what's happening, and then you see this fail, and then you join on the surprise down. So that's the other way to trade it, I think. So Globex high and the high from the 6th of April is up here. So I think we might have hit it. Yes, we've probably hit it already on the overnight. I suspect we're going to have to hit it at least on the RTH session as well, because it's a magnet from the RTH session, and that will at least put us into always in long. But I'd be, same again. I would be hesitant of rapid, strong breakouts in the middle of a triangle. So, okay, so we've just opened up at the Globex high. So up near the highs of the range. So we technically just ran anyone stops that were sitting up there. But we're in a strong trading range, so difficult to buy up here because, where do you put your stop? Below 78, probably a bit aggressive on the open. Booyah, I like your answer. 23 was a way for those bulls to get out. Yeah, and that's something that helped my trading a lot is, I would miss the move, and the first mistake is to decide to short, okay, because the risk is always smaller, not realizing that the probability is terrible, and you're going to constantly lose all those trades. And then by the time you've taken enough losses, that's a number of legs for that swing to be over, and then all of a sudden everyone else will get short as well. But to realize that if you've missed this swing, step one is, let's go bull swing. Bulls buying above, then bulls buying below. Right, so bulls buy above, then bulls are buying below. And at some point, bulls are going to exit. And then at some point, bears are going to sell above, and then bears are going to sell below. And bears are going to exit. ... So if you have that in mind, if you're long here, traders are buying the close, buying above, buying a pullback, then you're not going to sell below anything yet. Okay, first bulls buy below, bears sell above, and then it's not until here that bears sell below. And it follows this pattern over and over again, and that's really kept me out of trouble. So I highly recommend keeping that in mind. It also prevents you from getting dizzy, all right? So you're going down here, and then you see 56, right? But you don't buy above 56. All right, that's a classic beginner trade. You know, you've missed a bear leg and then now you've got a bull bar and you think, oh, it's time to buy. No, not yet. It's too big. No one wants to buy the largest bar of the day in the middle of the range at the moving average. That's exactly the opposite of where you want to buy. But a buy below there, where all the beginner traders put their stops, that's the better buy. So, g'day Johnny. Look, I've got DAX on my other screen, but I'm not. I was trading it earlier today, but I'm not trading it right now because I'm trading ES, and I've got the trade room. And I've got to limit how much multitasking I can do because it's pretty hard to do the trade room and trade ES profitably at the same time. Rose is quite good at doing multiple instruments, I think, because she's got a bit more experience trading in the trading room many days a week. I think women in general need to be better at multitasking. Anyway, I'll just put that in the chat anyway. So first part of the day, looking like a sell signal high in the top of the range at yesterday's high. This is a trading range, so reasonable for traders to look to sell up here. This is a trading range, so reasonable for traders to look to sell up here. We just broke out of this high, so I'm going to wait and see how this progresses. Like I said, this is a very tight trading range, 3 moving averages, so I think it'd be better to trade back into it. So big bear bar closing on its low. You've got traders selling the close. It's a reasonable trade to sell back to that gap. We've got a gap close. Where's the 3-to-1? I think it's probably more of a 1-to-1 here. Probably going to get to that breakout point and bounce. The bad head, eh? Thanks, mate. So gap up and market rejecting the gap up immediately with a sell signal. So it's trading range price action. So I'd usually wait before taking any stop entries in a trading range. Obvious magnets, you've got 73 high, and you've got yesterday's high, which we hit. So breakout, pullback for more up, breakout, pullback, sideways. For more up, breakout, pullback, sideways. Might just get rid of that daily EMA. It's probably a few too many EMAs on there. It's probably a few too many EMAs on there. Why are there so many boxes lit up? It's just way too many boxes. Bizarre. Oh, I'm not sure how to get rid of that. Oh, the camera. Yeah, look, I like the camera. We did our big questionnaire and no one mentioned it. So I thought, okay, maybe it's not a big deal to people. I thought it was good. I think there's a lot of kind of non-verbal cues and information when you watch a trade. And that's one of the reasons I think everyone should go to the trading conference in Orlando. I think it's really good to watch a trader. You pick up a lot of things. Watching Al and Ali in 2022, I picked up a lot of, subtle information. What does a trader do waiting for a trade? How do they react? I think that was really valuable. So you can see stop entry in a trading range looked good. Traders took about 3 points. And now what do you do if you're short? How are you feeling about that sell? Sound not working? Just let me know if it's coming through. Oh, trend line and unchecked price labels. Oh, thanks, man. Oh, brilliant. Have I got to do that for each of them? Yep. Yep, probably. Thanks, mate. Oh, that's a great little tip. Love a bit of trading view tips. Oh, I have to fix those other ones up there. Oh, g'day, Auntie. So a lot of traders would wait to sell the pullback into one. Okay, so you've got a 50% pullback there. Looking for a test of the 73 high. And you can see by waiting, obviously, you know, half the trades or a third of the trades you're going to miss if they take off, but usually get a chance to get a better order entry. Turns your 1-to-1 into a 2-to-1. Yes, Deepod, usually I'm the one with the tips on TradingView. That has bugged me for weeks as well. I really appreciate it. I was like, man, I can't find the settings because it was in the drawing tools. Have we got any newer traders or traders in the trading room for the first time? If I can kind of get a gauge of where everyone's at in their trading, then it makes it a bit easier to share things at different levels that I think might be interesting. It's a fun challenge to try and, you know, have kind of beginner, intermediate, and more experienced stuff in there, but yeah. No, awesome. Yeah, appreciate the honesty in here. Fantastic. Second time, first time was yesterday. Awesome. Well, I think you're in the right place. I'm biased. Of course, I'm hosting the trading room right now, so I would say that. No, but honestly, joining ours trading room was just a huge, just makes a lot of difference. When you watch someone not take the trades that you're constantly in and then take trades that you avoided, you know, you start that learning process to go back and review the material, and then you get that experience. And then the advantage is you've got like some emotional charge to that day because you might have had a good trade, might have had a bad trade, might have missed it. But then you can look back at that day and go, okay, with that setup and that open, that was a good trade. So if you sold the close of one because you were desperate to take a trade, how are you feeling on two? If you sold the midpoint of one saying, no, I'm going to wait for the pullback, see if I get myself a little 2-to-1 down to the 73 high, how are you feeling about your trade? You're 1 minute into the bar and we're still a little bit quiet. We're probably going to the middle of two just to keep the suspense going. First time, it's not fantastic. How to get profitable? Well, firstly, don't feel bad because it's very difficult. And secondly, you've got really, really switched on, aggressive, driven people trying to do their best on the opposite side of your trade. So, you know, it's not like you're playing a friend in a game which you're heaps good at and you're letting them win. They're very good and you're pretty good, and you know, you're absolutely doing your best. But I think there's a couple of tips that are going to help with profitability. I think Rose has just said there, profitability tips. And I cover these a lot. One is signal bar quality. And even before that, always in direction. And even before that, trend versus trading range. So, like that. So when you look at the charts, I believe you can drill a lot of things. So that means, you know, if you're Kobe Bryant, you're shooting 300 to 1,000 basketball shots a day. You know, if you're Tiger Woods, what does he say to kids that want to go into their first tournament? You need to touch a golf ball 1,000 times a day. And if you're a trader, well, you need to be taking a lot of trades, either on simulation or marking them up. Problem with marking them up is it takes very little mental effort. And you know this because you can do it for hours. All right? So you need to find something that's kind of stressful and it's going to really challenge your brain. So I would take an exercise and do, you know, 20, 30, 40, 50 charts and focus on one thing. So focusing on swing points. So if we go back here, we're always in short and we're getting lower highs, right? Lower high. Every time we get a pullback, the market goes lower and makes a new low. And this continues to a point until one is broken. Once that's broken, technically we've entered a trading range. However, if this goes to a new low, it doesn't matter. What does matter if we break above it and then we start going higher. Now, we've switched from always in short, either to a trading range or always in long. So at this point now, the swing point's down here. And then we do the opposite. So by doing an exercise where you go through the charts and looking at all the swing points, you will keep yourself in line with whether it's a trend or a trading range. And what's going to happen is that's going to be really easy for a lot of the chart. And then you're going to get to an area like this, where we didn't break a swing low here, and we didn't break a swing high until up here, but we broke it with a bear bar closing on its low. That's confusing. And what you get is this kind of trading range behavior, where you've got bulls that are long and bears that are short. So if you solve the midpoint of 1, you just got your 2-to-1 down at the high of 73. Oh, Edward, I've got a list of heaps of different drills. I'm trying to put them together in a better order to share. But I think they're great. Yeah, look, leg count's a great one. Breakout and follow through is a great one. Gaps. Swing points. Have I got swing points on there? Yeah, swing highs and lows on there. Second reversals, buy the close, sell the close. So we broke to a new high with a bear bar. That's not that bullish. And we've broken out of this. It's not really a lower high, but it was the range we're breaking out from. We've just closed that gap. I don't think this is very strong. I think we're more likely to come and close the whole gap. There's so many bear bars. But yeah, I would be trying to focus on one thing, set a timer for 25 minutes and do as many charts as you can. Take a break, come back and just do reps of that. So you can look at a chart and that particular thing you're looking at it just appears without you having to mark it up. So here I've got a lot of lines, but I think eventually you don't really need to put all the lines on the chart. So, and that becomes the homework every day. So you're not just marking up your own trades. Here's a chart, and then so you're looking at breakout and follow through. So you've got breakout and follow through, breakout and follow through, breakout and follow through. As long as you're seeing breakout and follow through, you cannot be short. Full breakout and follow through, you cannot sell anything. It's only here when the bears finally get a bear breakout and follow through where it switches to a sell. Switches to a sell. Does that make sense? So this exercise alone is, even if you haven't bought, you know not to sell. Oh yeah, it's a great Bruce Lee quote. He used to practice 1,000 punches a day, apparently. So it's a lot of punches. So small gap on the open. What's the point count? Okay, so 14 points. So when it's about 10 to 15 points, pretty common just to trade back to that gap. Bar 1 is the high or low of the day, only about 20% of the time as well. So, at this stage, hard to tell. We did break to a new high and we reversed down. I scalped out on my short there. Usually I would hold to close the gap, but whatever, shoulda, woulda, couldas. Can you sell here? I wouldn't typically sell at a moving average. For example, if I'm coming down to that moving average, I don't want to sell there. If I'm coming up to the moving average, I don't want to buy there. And we've also got 2 moving averages there, so twice as many reasons probably to chill. I think if you're short, you're still short. Stop above 1. We've broken the I don't know whether you can call it a swing high, but the high of yesterday at least, and the high of the day before. So will we start with a bit of an outside flavour today and break the swing lows? That's potential. The bulls don't have a place to buy, and they don't really have a place to put their stop. And so what will usually happen is that you'll just run any stops that are sitting in the market. So, you know, you've got bull stops that could be sitting there, down here, somewhere down here. And because there's no bull bars, there's no reason for traders to buy yet, then it's difficult for them to place a trade. And what they will usually do is use limit orders and scale into a position, hoping to kind of catch a bottom. But consecutive bear bars, always in short, I think you're either short or flat, but wouldn't be surprised if we reverse here. Yesterday's bar, Andrew, yesterday's bar 18, lower high MTR with the prior day. Interesting. Okay, so Andrew's saying we've got a bull trend, which we break. Yep, agreed. And then we're going to go back up and test where we broke it. There. That makes sense. And then I move down. Yeah, I think it's reasonable. I think it would be clearer on another time frame, just for everyone's eyes. Bull trend, break, and then test. This, to me, is a little bit too low. And I mean that because usually you can get it either lower high, double top, or higher high to reverse. But they act the same, and you know the mechanics are, as I understand, anyone that was long has a pullback that was too deep, and then so if we come back up, anyone that's still in, they buy lower, they get out, and that becomes a top. So we've got a potential double top with Monday. With Friday. Good 15-minute entry bar here, but low in a trading range. So targeting yesterday's low. I scalped and was waiting to see whether there'd be more buyers because this is a bull breakout. So I need to give the bulls a bit of a chance to perform that they didn't. It's okay. Well, makes me suspect that not as many bears would have got in. It's probably a bit self-righteous, but anyway, it's my suspicion. Trading range, back to the center. Can you sell down here? Big bars, big risk. You've got a 20-point stop, and your target's 10 points away. So the maths isn't great. Most traders shouldn't be scalping, because you have a high hit rate until you don't. And then you take a big loss because you have a high hit rate until you don't. And then you take a big loss. And you go, how come I won most of my trades, yet the performance was negative? So on the daily chart, this is what we were talking about earlier. You've got a bull bar in a bull trend closing above the moving average. That's good. We just triggered the buy above it, but there was a big tail on it. So it's not a great buy above signal. Probably a better buy the close signal, buy below. But it's also an inside bar, which makes me think perhaps the buyers will be sitting somewhere down there. But that's pretty far away. That's on the daily. Can you say bear spike, 3 pushes up, 1 pause, 2 pause, 3, wedge bear flag? Yeah, it'll be clearer if we see some follow through either side of the moving average. But at the moment, we're just bouncing back and forth. You're hacking my PL. No, it's annoying, isn't it? It's frustrating because you put a lot of work in and then you realize there's a bit of a hole in the system. Pat, do you let your stops get hit? Yeah, all the time. Unless I'm scalping or unless I'm in a trading range, I will, I'll try and reduce my risk as much as possible. So with a trade like yesterday's, well, yesterday's a bit different because it went straight to the target, 2 to 1. It was like, oh, okay, well, that worked out well. But let's imagine it didn't. Let's find Fridays. Yeah, let's do Fridays. Okay, so 3, decent buy signal, but an outside bar, so I'd usually wait for follow-through. Follow-through is pretty average. So I was sitting here wondering what to do. I thought buying under a bull bar was a good idea. So I bought the moving average with a half size, and I was waiting. Saw 12 and was like, okay, I've got to stop below 3. But if 12 closed on its low, I just closed the trade. Because my premise of a bull breakout is no longer valid if the pullback's going, below 65%. What I'm doing is buying in the top of a trading range. So that means you've got to buy there, and then to correctly manage it, at least in my view, you've then got to buy below, and you can sit in a dud trade for the next hour wondering why did you buy high again. So my alternative is I'll buy a partial, and then I'll wait to add on. Okay, and then you see 13, try and buy midpoint of 13. I think I missed 13. Might have ended up, I missed 13, buying the midpoint, and then bought on 15, I added on 16. So looks like buying the moving average there, and then buying there, and buying somewhere in there. And that way you get an average price, which is about right. Yeah, you get an average price, and then 3 decent bull bars, good entry, good follow through, 3 or 4 bars in a row. Thanks very much. I'll be out of that trade. And then high 1, high 2. So that's how I manage that. Because I'm mindful of this bar. Okay, so I'll give you an example up here. If you were long, say you bought 38, which is, it's a similar vibe. You've had a deep pullback. You'll probably get a second leg. By the time you see 43, 44, it doesn't matter if your stop's down here, I'm going to exit. I've got 2 big bear bars against me. I've got to close below my bar. This is not a great trade to be in anymore. Or it's at least the nature of the trade's different, so I want to get out. That's how I manage it. And some traders won't do that. They'll put the stop, and unless it gets invalidated by the stop getting hit, they'll stay in. That works for them. Yeah, well, that's the counter argument. Okay, well, if I'm not going to let my stop get hit, then I can kind of take any trade and just scalp out. And if your read is good, no problem, because you can have a really high hit rate. But at least in my experience and some of the experience of the traders I know, that can turn into zero patience and taking a lot of low quality signals. So yeah, I'd just watch that. Yeah, and then scaling into loser. That's the thing, because if you've got a decent read, so if your read's good here because you leg 1 and 2, no problem. But if your read's a bit late and this leg's ended and you're scaling into shorts here, or now you are, just going deeper and deeper underwater, and you'll be really lucky if you get out break even. It takes about an hour and a half of your life, and you think, damn it, I scaled into a leg 3. So yeah, leg count. Damn it, I scaled into a leg 3. So yeah, leg count. Yeah, plus the grey hairs. All the no-hairs. Yeah, and it's a good point about scalping. And I think it depends on your definition as well. So for me, scalping means the trade's, like 1 to 5 bars. It's probably about 1 to 1. Or I'm going to use my actual risk for the trade as opposed to my initial risk. And for a swing, minimum 2 to 1, I'm probably looking to hold it for, 5, 10 bars or so. I'm looking for the swing. A scalper is generally looking for, a bar or 2. in that direction, and the swing trader is looking for another leg. So the swing trader here sees this and is looking to buy to get up here. The scalper sees this and is just trying to buy underneath something and get back to where it is. You know, you get 1 or 2 bars and you're out. You make your 5 points and then you wait. Bear breakout, try and sell above. You sell and then you wait. A bull breakout, okay, I'm looking to buy below, I'm out. And they can do that all day, and they won't endlessly scale into a position. They'll usually follow the breakout. So you sell and scalp, and then you see this, well, you need to be long or out of your shorts. So always in short, we've got 1, 2, 3, 4 bear bars in a row. We've got an inside bar. We're at the open. Looks like the bears want to take it down to yesterday's low. They probably need to create some kind of pullback to reduce the risk. You know, some kind of little trading range to break out of. It was a sell on the 15-minute chart and just took off. And so while that's on, it might just keep going down. So if you're short, I would trade small. You've got consecutive bear bars on the 15-minute chart. So if you sold the close of 1, your probability was about 20%, maybe 30%. The 1's going to be the high for the next few hours and sell off. So you just got your 2 to 1, happy days. But if you sold 1 on any other day and took 1 to 1, then out of 100 trades may or may not work. 1, then out of 100 trades may or may not work. If you waited to sell 3, you got your 1 to 1 here, and you're hoping for yesterday's low. If the target's going to be down there, I think we'll need to come back and create a trading range so traders can reduce their risk and have another leg down, but we'll see. Yeah, Ed, I'm similar. I only trade when the computer's open, really. Like I've got high time frame trades that you know, if it's on the daily or the weekly charts, it's different. But if it's anything less than that, I'll take a look at it, I'll follow it, and it ends up being a real time suck. But then I'm okay with that, so I'll just trade while it's open, and I won't really look at the charts too much on the phone. And I certainly won't trade off the phone. I've seen a couple of people post shots of their trades on the phone. I would strongly advise against that, but if you can make it profitable, give it a go. So inside bar, outside bar, nothing for the bulls to buy here. So, you know, I don't want to be a buyer above 7. We hit the Globex high. Only 10% of days go down and hit both Globex high and Globex low. Back in the center of this range. 15-minute chart looks better for bears. 1, pause, second leg down. Hourly chart still needs follow through. If we look at the ETH has got a better sell signal, but closing right at the moving average. So let's have a look at that. If we go 50% of that, I'm currently flat. I'm waiting for a chance to sell above something, but it's a trading range, so often it can just go straight to your target. But I'm not on board, so I might just have to wait till it gets somewhere. So anyone that was long from yesterday, if you have a stop below 78, maybe a stop below 35. Because it's within 5 points, I think you need to stop below yesterday's low. The reason is if I'm going to lose a trade, I should learn something new about the market. At least that's my view. So 78 is kind of a skunk stop because you could go below it and come back up. But if we go below yesterday's low as well, now we've got an outside day. Tim, do you trade any other instruments? Yeah, I like to trade FTSE and DAX in the Euro session. I have traded the Nikkei and the Taiwan Stock Index. Used to trade the Aussie Index. Used to trade a bit of Forex. Now mostly FTSE, DAX, and ES. The tendency is to find the setups you like and then just find it on a lot of instruments, and you spend your time, a lot of time at the computer. And when I looked at my results, there was a bit of a cut-off point between just way too many hours on the charts and the quality of my trades. Yeah, DAX is fun. I like FTSE as well because it's, you know, similar price point to ES. So in terms of point count and movement, it's like, you know, same. And yeah, DAX can be fun if you're in the Eurozone, moves a fair bit. Yeah, DAX can be fun if you're in the Eurozone, moves a fair bit. The other advantage of having two different sessions a day is it's rare to have two tight trading ranges in the same day. So if you get like, okay, so one of these days I kind of looked at the chart and after an hour I was like, you know what, I had a good session on DAX. I'll just let it go. You know, you can kind of pack it in instead of pushing through. But if you're trading one session, then you just got to you know, manage your energy. In instead of pushing through. But if you're trading one session, then you just got to you know, manage your energy. I wasn't too good with commodities. It wasn't too good on the read. There's a lot of extra news you need to be up on. I've got a mate who trades it. It's very good, and it can be a little bit like Forex. You need to know your news. But Brad trades a lot of Forex, so I would definitely ask him. But Brad trades a lot of Forex, so I would definitely ask him. That's the advantage, I think, of trading an index fund is, you know, you kind of know which news events you need to know about. If you have a bad EU session, doesn't it affect your mood? Yeah, I think initially it did more. Now, not so much. Now it's like, yep, you finish the sesh. You know, you have a good trade that you add on or scale into at the wrong time, or, you know, lapse of concentration, you know, take a phone call. There's a whole raft of different things that can distract you. But then, you know, you just shut it down, go to the gym, have lunch, come back, and then now it's fresh. So that's it. Yeah. But it took a while to get there, like particularly ES, because you trade ES badly and then you go to sleep. So you can kind of stew on it for a while. Interested to hear how everyone else manages that. There's a good book, a couple of good books on that. I think In a Game of Tennis is a good one. I'm trying to think of the other one. Anything on state management, you know, how your body influences how you think and how you feel. I think that's good training. Getting some exercise in, crucial. So still always in short, looking like we're going to go down to the lower 78s, run those bull stops. Nothing for bulls to buy here, but not overly bearish at this stage. No, take a break. Take a break. Yeah, if you hit your target and you've done everything right, that's the great thing about this job. Yeah, I think it can be a bit of a mistake to just run the euphoria straight into the next session, as long as you're aware of it. You know, most people's biggest losses, or at least mine, are always after my biggest days. So you've got consecutive bear bars on the 15-minute chart, but in the middle of a tight trading range. We're down the bottom of this channel line, so bears are trying to psych everyone up to get short. Can you do Asia, EU, and US? Well, my problem is that if I do ES, by the time I get to sleep and then wake up, it's time for the Asia Open. So it's a lot of trading. I have tried it, but I found 2 sessions better for my profitability. But that's a personal thing. So I know traders who do all 3. I think some traders do 4. I think they do Nifty, or you know what I mean. I just keep trading opens all day. So possible high 2 here, but you're going to have a bull bar closing underneath that moving average. I suspect this is a pullback to go down and run some stops down here. I'd like to sell above a bear bar. I'd like to buy below a bull bar. So let's say you sold, or you saw 4 and you waited to sell. You had 1, 2, 3 chances to sell at that price. That's usually too many chances. Usually don't get that many chances. So 36 high, broke above, and then you had 5 to 10 minutes. Actually, 39 didn't quite cross it. So you had 5 to 10 minutes to take it. And then by the time you got the 3rd and 4th and 5th time, the trade was done. So let's see. So good bull bar 9. Location not great. In an always in short environment. So I think if you're short, you could stay short. But you've got a bull bar closing on its high. So some traders will get out and then wait and see they get a deeper pullback. Bears are looking for something like this, I think. 15-minute chart needs a second leg, I think. If you're bull, can you argue bull breakout, very deep pullback, and then second leg? I think technically yes, but I wouldn't be too keen on that second leg. You can see as soon as we got back to yesterday's open and above a bear bar, there were sellers. So let's see if they can scalp anything. So if 10's a good buy signal closing on its high, you'll have some bears exit above. But as long as 10 is not that, I suspect they'll hold short. First target are going to be the bull stops below 8 and 9. You could say micro double bottom, but in this context, is 8 and 9 enough to reverse this? Not at this stage. So. Okay, Sergio, how would you get at the MTR on Thursday? Hang on, Monday, Friday, Thursday. How would you get at that MTR? Do you mean on the 5-minute chart? I finished trading here. I was done for the day here because it's kind of my bedtime here. So I took a trade which was kind of low probability, bear channel, but I thought strong bull breakout. I've got to hold it for 2 to 1, and then I scaled out, and then my last target was I think back at the open, and then I missed it. I woke up and was like, wow, pretty big move. The thing is, I could say, yeah, I feel bad about it. But the thing is, when you trade this, you never end up holding for that much anyway, right? Because that's the day you're looking at. So all your calculations are based on this range. And then, so it's very difficult, so if you're catching that move, it's on a small size, really. Yeah, because some of these bars are 20 points tall, right? It's 10. One of them I thought was 20. It's not a style of trading I've been very good at. but it's okay because I can I make up for it in probability. So always in short, you're either short, waiting for your targets, looking for a reason to exit, or if you're looking to buy, you're looking to buy below something, looking for the bulls to do something. But give the bears 60%, not just because I'm short. Nice. So 10 didn't get the follow through from 9, so not great for bulls. More likely we're going to the 9 low. Yeah, Vikram, that's a really good point, and I agree with you. Let me just, I like that comment. Because that's psychology of, like, you look at the chart and you think, oh, I missed it, I should stay up late. That ends up with over trading, at least for me. So if I'm at the chart, I'll trade what's there, and sometimes that means, you have to, you only get a few points because it's a tight trading range and it's a difficult read for my particular style. But I think it takes a while to get to that stage where, someone sent me a message about this the other day. If you're having trouble with profitability, I would start with green days. Okay, so if you're up, you've taken a couple of good trades, you shut the laptop down, and then you mark that as a win for today. Okay, and if you get to Thursday and you're having a green week, then you shut it down, don't trade Friday. Now you've got a green week. If you're 3 weeks into a month and you're plus, have a holiday for that week. Do something else, hit the gym, and now you've got a plus month. But I think it makes a psychological difference because you're like, oh, okay, I can turn up each day, and even when I trade badly, it's not too much. It's not too much damage. I'm pretty consistent, and then you get that bit of routine, rather than just trading until you take a big loss and you're like, oh dear. Friday, yeah, mate, Fridays. We've all been there. It's been a while since I've dusted a whole week's profit on a Friday, but I did go through a couple of years of that, and it's just a nightmare. And then your partner's got to deal with you all weekend, or your mates have got to deal with you all weekend. Like, mate, everything was right, and then blah, blah, blah. So if you can artificially get out of that cycle by, and some traders are like, never do that. But I don't know, for me, I was a big fan of it. I'm already up. I've done the right things. I can go to bed and go and do other stuff. And I did everything right today. That made a big difference on my psychology. The other loop I was stuck in for a long time was the first trade of the day being an absolute shocker, then having to spend the next few hours to get back to plus, right? Then you take a good trade and you're finally up on the day, only to do another 2 trades which wipe it out. That was a really tough one to get through. Oh, man, it's just brutal. So when you see big moves on the open, and that's why I'm so calm on the open, if you have a big move, I'm like, I don't care, because the feeling of that, of taking a trade that goes south on the open, whereas when you get into this stuff, for me, this is easy to trade up here. But to manage this stuff's difficult, But in a trading range, I'm pretty comfortable. So yeah, micros, mate, macros, very easy. Very, very easy. And to be honest, you can have 6 micros and a scaling of 6 micros and scaling of another 6. I mean, you can make pretty good coin, when you start to get consistent without switching to many contracts. So I see in the chat, people like, I've closed some of my position, I've still got 14 contracts on. I'm thinking, man, I don't know what you're trading, but you're trading a very big size and also chatting. So just a huge size. It can't be only Aussies that say blah, 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 surely. Well, just 4 red days in 2024. Good on you, man. Oh, Ted, you're trying to hit the exact target. Yeah, I know the feeling, man. Oh, I know the feeling. Yeah. it's just off the target you want. It's just a couple more points. Pat, I often say this, book 2 is my favorite. So, if you understand how trading range works, you're going to be able to do you have a lot of opportunity for trading. That's my view. But also it can be, the moves are strong, moves are fast, so it's a bit difficult. So what's going on here? We're always in short, and what we said earlier is bears probably want to get some kind of trading range here and then do a breakout measured move down to these targets. That makes sense. So 12, 13, pause, and then down below. And this is where the bulls want to get another bar like 9 and trigger it. So they triggered one good bull bar, but they're probably going to need at least one more. One more tick. There we go. You beauty. So I sold the open on the pullback, and then I had my order to get out of the 9 low. So now we've got a new breakout, so traders are going to sell it. They're going to keep going down to the lows. Happy days. If you also think back to when you first started learning trading, or if you've just started, you can just look at your current trading and say, okay, where do I want to get in? Okay, well, if I've just started trading, I'm going to see 4 and I want to sell the close. Okay, and that's fine. But the stop's up there, and sometimes you've got to sit through 5 to 10 bars of a pullback to create a smaller range for everyone to load up to then push down to the next target, right? And what traders often do when they first start trading, or at least what I did, is I would sell there, which was all right, think that the market's reversing, get out, only to watch it do that. Okay, that's really annoying. Down at the Globex low, we are a point off yesterday's low. Okay, so we just now got an outside day. There you go. Happy days. We all make a little bit of money there. Paid for the trading room. Maybe not paid for Orlando, but certainly paid for all the coffees and baked goods we're going to consume there. There's actually a little Starbucks, 25 meters from the front of that room at that conference center, which is fantastic. Excellent. Wonderful. That is brilliant. Andrew, that's brilliant. I think that's brilliant on the micros. I think that's great. And that's the best thing about it, is that you've got an option to trade small, and then you can just focus on getting points. Oh, you cut on the pullback. Yeah, so man, it happens. It happens. So the alternative, like I said before, is I want to sell above a bear bar, and because you got an OHLC magnet here, you got yesterday's open, so that was my sell. And then I'm only taking this bit, and then I'll usually run the second part of the position for another scalp and get out. You know what I mean? I've taken most of it here. The alternative is you can trade your regular size in here and then just switch to micros once the bars get bigger. But every day there's a lot of this stuff, so I've just kind of perfected this stuff. So collapsing through all those magnets before, so looking like wedge bear flag, 1, 2, 3, and now we've broken below Friday's swing point. So the next swing point is, Friday's swing point's there. We're about to break through it, so we can get rid of that one, get rid of that one. What's up there? So we had a sell signal on the ETH, but I think because of where the close was, I think we'll probably hold it down to here. So, maybe pull back and go down, but at the moment, absolutely collapsing. So get some good wins, small losses. Small. Yeah, good question. Okay, so good things is saying I get some good wins, a lot of small losses. So firstly, congratulations on the small losses. Okay, so I would highly recommend that being a bit of a KPI. So if you're taking big losses, there's only a couple of ways to take big losses, and that is I'm buying up here, but my stop's down here, right? That's how you take a big loss. He stops here, and this risk reward doesn't make any sense. All right, I've got a 30-point stop, then I need at least 30 points profit. All right, and ES doesn't usually move that much in a day, so that's a problem. The alternative is wait for a pullback and then use that as your guide. Okay, so if this is the breakout here, for example, let's take Friday. Friday was like a pretty textbook example. So breakout forms a pullback, which is like a mini trading range. You either buy a high 2 in here, buy the breakout, or once again, you wait for a pullback to the breakout point. Wait for a pullback to the breakout point. The advantage of taking that trade is your risk is very small, and if you get an adverse bar here, then not a big deal. You can get out of that trade. The advantage then is you can add on, and you've still got enough points left in your target. If you're taking big losses because you're scaling in, you're usually scaling in that you've forgotten leg counts. Okay, and we pointed that out yesterday. Pointed that out before here. This is a strong bear move with a couple of legs, and then you're scaling in your shorts up here. Okay, so the first one's understandable, but then you just keep selling, selling, selling. Yes, it worked. And you can say, yeah, it works a lot of the time. Problem is, what happens if that doesn't work and you run that stop up here? That is a lot of points. That's going to undo a whole week of good stuff there. So if it's a late leg, no more scaling. Still fairly on the course. Yeah, I would say definitely be drilling different techniques. You know, set a timer, find a technique, you know, break out and follow through, you know, swim points, always in long, always in short, and just try and not get your reps up. That's going to help improve your price action reading. And that's, I think, essential if you're then going to add 2 time frames, 3 time frames. Like here, I've got the hourly, I've got the 15-minute, I've got the 5-minute, but there's 3 lots of price action here. So when you start off, just have 1 chart and just get very comfortable with it. So for example, here, 1 leg down, pause, 2 legs down. What do you do here? Do you sell here and put a 20-point stop up there? I think probably not worth it. Laser, yeah, good point. Yeah, definitely finish the course. Got to do that. It's a good call. When breaking even or fixing, I don't use the word fixing, Surur. If a trade is broken, I will usually just exit that broken trade. Otherwise, I'm trading in a place where I'm scaling in, and then it's not really broken because my goal was to scale in. So I'll give you an example. Here, bull breakout, buying below a bull bar. If I buy here, but then this is a big bear bar closing on its low, let's copy one. Let's get all technological on it. Okay. Okay, so that bar looks like that, right? I am not going to fix anything here. I'm going to go, okay, well, I just took a 5-point loss and I'm going to get out of that, because a day that looks like that is unlikely to have a strong bull breakout, right? No one wants to be long up here anymore. And you can argue, yeah, but we'll probably pull back and then sell. But I would prefer just to get out of that trade and then look for a sell. So I take the loss quickly because I get a bit stressed if I'm sitting in a losing trade for a long time, and then I find I miss a lot of trades. So. The measured move I've got here is the overnight 60-minute bar, which took off. So that gives us a 52.17. Which took off. So that gives us a 52.17. I'll just mark it on the charts for you easier. Get rid of that. Get rid of that. So very climactic, and this was a problem back here when we said bulls don't have anywhere to put their stops. and they're going to try and pick places at random to buy, the traders that do that. And obviously the problem with doing that is occasionally the market will just go through all those points. So you buy yesterday's low, you buy 20 points lower, but how big's your account? You know, you're going to keep doing this every 20 points. You're going to keep doing this every 20 points. Yeah, that's correct, Sarah. Yeah. Thanks for joining on the trade room. By the way, appreciate the questions. By the way, appreciate the questions. Yeah, and that trade would be different, for example, from a high 2 or a breakout trade here, where I wouldn't be expecting to scale in. I'd be expecting this to go somewhere. Okay, if that trade was up here, let's give it a different color. This trade buying late with a wide stop, this needs a scaling. This is more of a breakout trade. So if that's the breakout trade, because now you've got to have a wide stop. And what you're saying is you probably missed a lot of the move. And you can see here, buying in there, traders have to scale in to get out. So, yeah, no worries. So still always in short. I scalped up here on 2, and I scalped here on 10. I took most off at the 9 low. I've only got a very small size on the back end, and then that closed out 66 low. So I've not missed this bit, but that's okay. That's okay. This green box is not a Tim's going to buy there. This is 20 points below this, basically. Trying to demonstrate if I just buy it there and then buy 20 points below, it's probably going to go back there. The question is, will you? So that's the midpoint of that bull bar. So I said earlier, we've got outside bar, inside bar, but bull bar at the moving average in a small pullback bull trend, not a great close. Okay, so I don't want to buy above it. Don't really want to buy the close of it. So I said, well, maybe the midpoint or maybe below it would be a better place potentially for traders on the daily chart. The other place would be below this bull bar down here. That was the failed bull spike we talked about earlier in the session. A strong bull spike, you expect a breakout. But what happened? Mayo, no breakout. So if we go below that, breakout pullback, potentially measure move down. Below that, breakout pullback, potentially measure move down. So it's sell the close, but if you're selling very small. You know, your stop's 30 points away. So you're probably not going to be on a huge size. Mayo, that's it. Mayo breakout. Thanks, Guangqi. What's breakout in Zhongwen? I should learn all the trading acronym, all the trading words in Chinese. It's funny because when I go to cafes here in Taipei, trading is super common. Like the most common thing to see on an iPad or a laptop is a chart, but all the charts have the bull bars are red because red's lucky, and the bear bars are green. So it always trips me out a bit. 这个很快, huh? So fast to the downside. So we just retraced all of Friday, and we've got Friday's open here. I'll just get rid of all these boxes for now. I'll just leave that one. So now we're within range of the high of last month. I said at the start of the day, be pretty unlikely we got there. Well, now it's looking a little bit more likely. A, be pretty unlikely we got there. Well, now it's looking a little bit more likely. And I really should get my Zhongwen up a little bit better so that I could do the Chinese translation of the trading room. But because my Chinese is so bad, they might just think I'm a terrible trader. This guy speaks like a 5-year-old. So, mine's probably still worse than what yours, Huang Chi. So we're back at Friday's open. So we've totally retraced that move. So always in short. Oh, thanks, Tim. That was hard to tell. 4 huge bear bars, all closing on their lows. Always in short. Oh, thanks, Tim. That was hard to tell. 4 huge bear bars, all closing on their lows. Yeah, why is he buying green bar? Yeah, I know, man. It still gets me. You just sit there and I'm staring at it. And but their trading platforms are pretty old school as well. So if I was in your position right now and I just started trading and I was looking at this, I would not be trying to trade anything. I wouldn't even be trading 1 micro. I would just be watching it and go, wow, that's a lot. And then I would be looking to trade the second piece of it. On the 5-minute chart between days, this is a common trade here, right? So let's say if we put a red box there, traders will sell the first touch of the moving average. So there was a possible limit order sell there and there was a possible sell there. Both failed. And those bears had a really hard time to get out. I mean, I think if you were short there, you had enough chances to sell above something here to get out. But interestingly enough, we've come back to that price. So, g'day Panda, Kung Fu Panda, great movie. Where do I see the questions you're answering in the room? Mate, I'm just going off the Discords. I have not even checked GoToMeetings. I don't even know. Questions box. How do I do the question box? Chat? Man, I have no idea. I've never clicked any other buttons on GoToMeeting except become presenter, transfer. So, yeah, so Panda, if you just ask on the Discord, I'll go to him there. Okay, so what do you do here? You want to get short. So, okay, so what are your options? Well, one is you sell and you put a stop 45 points above, bearing in mind that if you've got a stop that's 45 points above, you are at a minimum expecting to go down there. Remembering that we're in a bull trend on the monthly, aggressive bull trend, and that this is the breakout point of a bull bar. So I'd be surprised if we didn't bounce here. So can you just go down a time frame? I think, who said that? Can you just go, Daniel, a good question. Okay, so we'll go down to the 2-minute chart. Okay, so a lot of traders are going to go down to a smaller chart, look at this moving average, and they'll go, okay, here's a moving average there. Spike and channel, here's a trend line there. Okay, well, I want to sell in the midpoint. But you still have to find a place to put that stop. And at the moment, this is a micro channel. So your breakout point's up there, 49. So you still got the issue of where do you put that stop. We haven't created any pullbacks here yet. So for me, climactic, and then the pullback can be quite deep, and the moving average is there. So, you know, you've still got 20 points to your scaling. So we're finding buyers at the Friday's open. I think if I was looking at a smaller time frame to get in, wait for, same thing, wait for a trading range and look for a breakout of that. Because the expectation is more down. But it's the same thing here. Where is your stop going to be? Because it can just keep going all the way back up against you. So I think the risk reward's bad. Bear micro channel, very strong, lots of momentum. Get rid of those. So low probability buy, high probability sell. Question is, how do you get the risk reward right? Outside day, trend down, back to the breakout point. Outside day, small pullback trend. Didn't quite get to the breakout point, but here didn't quite go that far below yesterday. Ours is a bit different. Ours is a bit more aggressive. Let's find an aggressive one. Okay, this is more aggressive. So here, spike, and then channeling down for the rest of the day. So that's one possibility for today. I think that's another possibility. Someone's asking how to get short. Look for a breakout point, test of a breakout point. Because we've gone down so far, we need to pull back for traders to reload, I think. So that might be a bit of an issue. So will this be spike channel? So strong move down, and then some kind of 45-degree channel down this way. Or will it be sell climax back up to the breakout point? This stage looks more like this. I'm expecting buyers down here, particularly at the higher plus month. He was using his inner voice. Sorry, there wasn't any real developments here. We've got bar 18. So what do you do here? So traders that sold low. This breakout point, 52.31, that was the swing point we broke out of. I put a measured move from yesterday's high, and yesterday's low. That was the one-to-one. But I suspect we might do similar. You know, if we are going to the high of last month, then we need to pull back. Does everyone understand the reload concept? Is that just, I mean, I know there's some got some newer traders in there. Happy to explain it. Okay, so if you imagine that you have an account, let's imagine you got $1 million in your trading account, and you've got a certain percent of that account that you're going to risk. Okay, and in that trade, so what you're trying to do is you're trying to come up with a number of points and size that's going to make sense for one trade, right? So if you split that trade up, maybe you've got 2 or 3 entries into that trade, and then your stop is going to be varied on each trade. So at some point, when you get down here, you've got no more capital available to get in. So what the market has to do is has to create a top, has to create a place for your stop to go, so the stop's no longer up here. It has to go from here down to here somewhere. And once we get down to there, now you've got a much smaller range with which to deploy your capital. And that means you can trade a much bigger size. So the reason up here, let's just make that a bit bigger. So you're short into here, your stop's 15 points away. We think we're going down to these magnets, but my risk is still up there until we create a lower high. Once that lower high is there, the moment we break out of that range, the stop is now how many points away? Stop is only 6 points away. Great. So you've got a whole much more capital that you can now allocate if you still want to get short. And as this bar's going down, no problem. But as this gets bigger and bigger, your open profit's going to get bigger than 1%, 2%, whatever your size is. And for most traders, I would recommend it's much smaller than that because you're going to split it up into several pieces, keep yourself relaxed. And by the time you get down here, you're actually going to start scaling out because you're going to be above your threshold. You get down here, you want to get short, but you need a lower high to move your stop. So does that make sense? So you want to sell, the stop's too far away, which means your size is small. Oh, great. Nice one. So you can sell, but you're selling on, you're probably selling on a couple of micros. If the stop's 60 points away, depending on your account size. And if you're usually trading a few contracts, then it's not going to be as exciting for you to trade 1 to 2 micros. Right? If you're comfortable doing something much larger, then that's not going to make sense. So what can happen is you have a lot of periods where the market's going sideways where that's happening. So here on Friday, market shoots up. We've got magnets above. Traders that want to get long are waiting for a small trading range to break out of and then break out of. And then bears don't have the same issue here because their stop's really small until their stop gets really big. And then the same thing applies until a breakout and measured move fails. So 18, big bull bar closing on its high, strong reversal. 19, super important. Is 19 going to be a bull breakout above? If it is, there's going to be buyers below 18. Although I'm not recommending anyone buy. I put these two imaginary channel lines on the chart because I suspect we're going to have a spike in channel. Yeah, Johnny, I'm waiting for another reason to short. Potentially we need 2 legs sideways to up. If that's 1, pause 2. If this is a trading range we broke out of it and that's the spike, then I'm just waiting for this pullback to end. Some traders will sell up here. Let's get rid of the green boxes. And we'll say this is the start of the channel. But yeah, the issue for me is the stop. So if you're scalping, you can use a lower time frame. There's other ways to do it. Okay, so now you've got a bear bar potentially to lower your stop to, but now you need a new low. So it's like you've still got to structure the trade the same way. So I'm going to wait and see. Let's see what happens. It's an outside day, which means we've got a bull breakout. Now we've got a bear breakout, and most of the time, these days end up in the middle somewhere. So I've got to be a bit careful where I sell, I think. Okay, so what do you do on 19? 19 not good enough to sell, so 1 pause, so probably 1 more bull bar. Let's see. Far away from the moving average, and the breakout point is not too far away. So the bulls are doing the opposite. The bulls are saying, yeah, look, let's have a crack at the moving average or the breakout point. So they're hoping for pullback and then up to that breakout point. But the bull trade is for a temporary, close to magnet, I think. It's not like, possible low of the day. So this is what the bulls want. Find a good bull bar, buy above it, small pullback, bull trend, all the way back up. But in both examples, struggles to get to the high of that sell climax. And it was never very strong in this. That's a couple of possibilities. I'll put that in the Discord. How good's this, Rose? I'm screenshotting and put it in there. Have we got any more tickets, Rose? Did we sell the last few tickets? 3 left. There was 4 left and then 3 left. These other ones are going to apply. Okay, that's the other one, the bulls lot. All right, we're going to have to get a bigger room next time. Fantastic. Highly recommend that traders attend the live webinar. Great fun to watch traders in action. You can ask questions. The The guys can sign books, and actually, you know, just really great people to meet. I was just surprised. You know, I wasn't sure. I'd never been to a live trading event before, and yeah, some really good people. I was like, man, this event was too short. Too short. You know, as Al says, you know, demonstrate that, you know, traders are people like you, and trading something that is possible to do without all the hype and you know, Lambos and crypto bros and all the other stuff the internet seems to push. Well, the pool's right next to it. Actually, that's not bad. We can put a projector up there. So at the moment, anyone that's sold low in here, how are they thinking about 18, 19, 20? Okay, so it was sell to close. Stop was far away. And like we said, need a chance to reload. So traders going to expect a couple of legs sideways to up. This is 1, 2, 3, 4, 5, 6 bars down. So we probably need, you know, 3 to 6 bars here. Moving average here, breakout point. Someone was asking about where I'm looking to sell. Yeah, I prefer to see what happens at the breakout point, you know, above 15, somewhere around here. 18 was really strong. Didn't get immediate follow through. So a couple of things have to happen. It was low probability for bulls to buy here, and they made a scalp. Great. For more bulls to buy, it needs to pull back, give them another buy signal. Bears need something solid to sell, so we might be going sideways here. Oh, Edward, don't be silly, mate. It's just practice and experience. But, you know, get your reps in. You know, get out Ninja Trader, get out Market Replay. The thing is, if you're taking 3 to 5 trades a day, right? You know, you look at it. I was saying, you know, Kobe with, you know, as a basketball player, you know, basketball players are shooting, you know, 200 to 300 hoops a day, but he was shooting 1,000 every day. You know, golfers are hitting 100 balls. Tiger Woods is hitting 1,000. So there's a real opportunity to get the reps in, and a lot of it's muscle memory. Oh, we're down to 2. Nice one. My joke, I'm Dad. You know, pick trades that match your personality. Pullback sells to a magnet from yesterday. This matches my personality. Trading range breakouts match my personality. You know, did it on Thursday, Monday, type trading range breakout, and then sell back to the breakout of the triangle. High 2s of the moving average, you know, weak trend on the open, test of the high. You know, and you repeat the same ones each week. They never look exactly the same. You never know when they're going to set up, but the execution is pretty similar. See, there you go. You got Rose as well saying the same thing. Market Replay, it's free. It's you know, if you take a dud trade, download the data and just go and play that trade again correctly. Like just relay the neurons. Don't buy here. Wait for the pullback. Reduce size. Thanks, Rose. Any other tips? Rose might have some more tips for you. I mean, you've got 2 options. Either you can just spend all your capital on mistakes. That sucks. That sucks. I lost way too much real money before I discovered how good Market Replay was on Ninja Trader. Oh, nice, Pat. So you can do a sim on TraderBet. Anything that you can concentrate, and you don't have to do it on regular time. You can do it double, triple. But I would highly recommend, here we go, let's write this up. It's good stuff to write up. I did a lot of this. You actually sit in bad trades and don't change the speed. Just sit in it and go, okay, I've entered it, and it never really did what I needed it to do. Okay, so let's as an example on 9. You buy 9, it's low probability. Right, it's the first decent bull bar, and it's occurring after a bear spike. So the chance of this being the buy of the day, very low, 30–40%. The chance of it being a place for bears that are going to sell, probably 60%. So if you buy above 9, it goes in your favor about 1 point and then pauses, and it never came back in your favor ever again. So what do you do here? We had a big spike down. Bears want a second leg. We've got an inside bar. So what do you do here? Is this likely to be a bull breakout? Well, I think if they get to the breakout point, that's probably going to be the best the bulls can get right now, because on a higher time frame, you know, probably sellers above this 15-minute bar. This is huge on the ETH. If I go to the RTH, so you're going to have sellers sitting up there. We're sitting on the 200, but it looks like, you know, you could say this was a second leg from that, but that probably needs a bit more. Maybe this leg will be, you know, broken up 1, pause 2. So one problem the bears have now is that we've got consecutive bull bars on the 15-minute chart. So still more like a pullback. Probably going to find sellers here. If I was long, which I'm not, yeah, they're one-to-one targets, the breakout point. Okay, so, and this is the danger with selling down here with a wide stop is you're probably going to close your trade early and not actually let this risk reward play out. So in future, you can say, okay, I'll wait for the pullback, wait for 2 legs. We haven't gone below the low of a prior bar, so this can all be 1 leg. So if you're a limit order bear and you sold above 15, how are you feeling about that? I won't put a limit order blindly at that breakout point. It's just an area I'm watching to see. This channel now doesn't make any sense like that. I'll say like that. I'll say. So bears giving up on 22. Those that sold late, I still had positions running. Yesterday's low is a breakout point, and this is the top third. That's another trade I like. So, okay, so that's my short idea up here. If I was long, say you bought 18, there's your 2-to-1 target up there, which you really need if you're taking that trade. So can you buy 22? Well, you're buying at 1 pause, 2 pause, potentially a third leg up in what is essentially a bear spike. So you're buying there, you're putting a stop down here, and you're saying, yep, I think we'll get back to yesterday's low. But it's only a 1-for-1 at this stage, so I don't think it makes sense. I think this is a sell zone. The 15-minute chart had weak follow-through, so potentially sellers up here. I'm flat. I'm waiting to see if we get a sell signal. We've got the original greatest of all time, it's Dr. Brooks, coming in about 10 minutes as well, which is going to take us through for the next couple of hours. Bulls want to get another good 15-minute bar. Suspect they won't. So you can see anyone that's sold down here at the scale in 20 points. Okay, so if you're a bull and you took a low probability trade and you got 20 points, then you're thinking, well, that's pretty good. And if you bought late, even though you haven't hit your target, you've got to expect some kind of a pullback here. Bulls didn't get to the moving average yet, and they haven't got below a bar here. So I don't want to be long here, and I haven't got a sell signal. And that's pretty common. I think I had a bit of an issue with that when, learning trading. I've just felt like I needed to be in a trade the whole time. And I've tried that style, and I can sometimes get a bit dizzy. Whereas now I've got a few setups I like, and I just try and, put more size onto those, which I like. So bear's got the same issue. Where do they put their stop? Ideally, you want a bar that gets a bear breakout, and then put your stop above it, above a decent bear bar. So bears that were waiting for a sell signal to the moving average. The reason I've got this fib drawn here is if you think about market cycles, so spike, pullback, channel, and then leg 2, two-legged pullback, leg 3, trading range. So what I'm saying here is at some point this spike is going to turn into a trading range. If it does it quickly, this will be the sell zone. Okay, it's very unlikely for this to just go straight up to yesterday's low and then up here. We've got some body gaps in here as well, so let's see what the bears can do. Another inside bar, you've got 1 pause, 2 pause, 3. So bears looking for something to sell, possible wedge bear flag at the moving average, but this is pretty strong, so expecting a bit of a trading range. Top could be this breakout point, the top could be this breakout point here, it stays low. What's that awesome wedge at the bottom of the 1 minute? Ah, nice. So magnet at Friday's open. Now we've got 3 legs up. So break a trend line, pause, and then drop off. If you're comfortable on a lower time frame, no problems. I found that I used the lower time frame because I couldn't be bothered waiting for a trade on the 5 minute. That was just my personal issue. So I resist the temptation to do it too often. Because once I switch to the 2 minute, then I don't usually go zoom back out again. Yeah, Ash is talking about simulation in TradingView. Look, I think it's great. One of the advantages is it's cheap, and you can only buy the close or sell the close. So, okay, let's say, do I sell the close, buy the close? Okay, I'll wait for a follow-through bar. Now I've got a follow-through bar. Okay, so I can't use limit orders on this, but if I sell that, then I can enter there, and then I can put my stop at the top there, and then my target's probably going to be yesterday's open. So 2 minute or 1 minute. If you can get the 100 seconds. You can get it on NinjaTrader. For some reason I can't get it on TradingView. It was an idea I got from Ali Moinafshari, which is a 5 minute bar divided in 3. I thought it was very smart because I look at a 5 minute and a 15 minute, so that was good. But a 2 minute setups are very similar. So inside bar, small bar, so we might go above and below this bar, but I suspect if you were long in here, you might be considering where to get out. You're probably going for the moving average. This was a breakout point from Friday, and we're always in short. So it was only really a scalp, at least in my view. So it looks like we're going to try and set up a low 2 near the moving average. We haven't gone below a bar yet, at least on this time frame, and we can zoom down, see something similar. But it might be the case that the bulls are going to give up around here. So you can see, if you're looking, someone's asking how to get in a bear spike. Sometimes you can look at where the bars are overlapping as places to get in. Usually I think leg count's the most accurate. 1, pause, 2. Wait for 2 legs to finish. Wait to get some kind of a lower high. Okay, so we just broke out below a bear bar there. So some sellers will sell there, others will wait to sell above. I think most traders should wait for good stop entry. TradingView is free. You just sign up and then you get a little account that you can reset the SIM. Now we've got Dr. Brooks joining us very shortly. I'm just going to check on how to do the handover. But thanks very much, everyone. Really appreciate the opportunity to host the trading room. Highly recommend it, and welcome to all the newer traders here. It really helps me improve my trading. So, thanks very much. If you've got any questions, please send me a message. And looking forward to seeing you in Orlando as well, which would be fantastic. It'd be great to catch you all. Awesome. Thanks, everyone. Wonderful. Okay, I will jump off, and happy trading, everyone. We'll see you soon. Yes, welcome back, everyone. It's Tim Fairworth again, your favourite Australian price action trader. I'm just going to keep going a little bit longer until the doctor is in the house. Just let me know, is that mic coming through okay? I think I'm sharing the right screen. Fantastic, looks good. Do you guys miss me? Welcome back. Thanks, guys. Oh, it's been great. It's a long 5 minutes, I know, without an Australian accent. So we got a couple of bear bars. Bears were looking for that low too. Not a lot of sellers immediately that bar. More buyers there. I suspect the first sell is going to be above something. There's a chance this could be the low of the day. Problem is on the higher time frames, 15-minute chart, the hourly chart, these are strong sell signals. Oi, 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 the boomerang. That's it. You can't get rid of us once we're in there. So the issue is, if you're buying here, where do you put your stop? It has to go below 17, the Friday's open, and your target's really the breakout point. So the bulls need to get above these bear bars. So 3 bear bars, probably sellers up there. I think the first sell is going to be up here. Some traders can already be short. They'll see consecutive bear bars inside the sell and probably scale in higher. Some traders can already be short. They'll see consecutive bear bars inside the sell and probably scale in higher. I took a small position short. Got a lot of equipment happening right now. So spike, pull back, and I thought one of these overlapping bars would be the start of that channel. Maybe it's here, maybe it's there, probably somewhere in here. Can the bulls do what they did on Friday, which is just breakout, pause, and then more breakouts? Well, here there's bull bars closing on their highs and overlapping. All right, so let's just copy that. Let's go along here. Oh, we're using the wonders of technology. Let's get rid of that, make it a bit easy to see. Where did I get short? I sold half of 24. So I thought, I do that a lot. I think, okay, well, 24 is my sell signal, but because we're going up, I don't want to sell below something. I want to sell above something first. Do I have that order? I posted that order of trades, right? Sell sell below, sell above, buy below, buy above. That it follows that flow. So I see a potential sell to close or a place I want to get short. I've got to hit my mouse hand and be like, don't sell there, sell up into that bar. The advantage is, right, if I do that, because I can show you when it works and show you when it doesn't work, and then it's a bit easier to manage. So that's my first position. Right, and you can see other traders were doing that. They didn't immediately sell, they waited. So then a logical place to sell would be at this breakout point here. But it also gives me the opportunity, if 27 is a big bull bar closing on its high, that I can exit with a couple of points and then just wait. So it gives me a low risk way to get in. Because it's a trading range at the moment here, bull spike and then pull back. I don't think, so that's more than 30%. Yeah, it's not really at 50% yet. So, selling at 50% is a great place. In a strong trend, 30% is good. 50% is usually safe entry. What I don't want is the bulls to get a good bull bar, because then they'll start buying below. I want this to kind of do what we did here. That's what I'd like. So we've got bear bars not closing below the low of a prior bear bar, but going below, which is probably enough in this context. So probably sellers of the moving average. Ooh, Royal, good one. If we go above 52.31, yeah, so what Royal's saying is if we go above there, that would be an outside down and then back to the high today. I would have to look in the encyclopedia to see how often that happens. Outside down, or outside days usually end up back in the middle. And if I put the middle of the day on the chart, mid, that's the mid. So what I would say to that, Royal, is there's probably a few checkpoints we've got to hit first. So first, sell the low 2 with the moving average has got to fail, set up measured move back to close this breakout point. If that's strong and then the second leg from this fails, then you've got a chance to get back up to this trading range, back to the open. So there's probably like 4 little milestones in there. There's probably like 4 little milestones in there. "15-minute chart, lots of tails, so you'll have 15-minute bears looking to sell, but so too much momentum for me to be short there. I'll just wait and see what happens here." See, that's the advantage. So you're only risking a couple of points. And it's got good risk reward because you've got the probability of it going down much lower and you can add on. Can you buy 27? I think better to wait to see if 28 has a follow through. You've got traders who are looking at 18 as a possible swing buy, trying to take the 2-to-1. They're at their 1-to-1 target for 27, and they're looking to get back up to yesterday's low, the mid. So that's reasonable magnet there. So because the stop's not very far away, it means that your risk is small, which means the probability is small, but then it becomes easier to make a 2-to-1. So when everyone else is going for 1 for one of those bars, because you've got a better entry. So if you're buying around here, you're saying there's going to be no sellers of the moving average and we're going to go right up to middle of the day, lower yesterday, about 10 points away. Lower yesterday, about 10 points away. Bulls need to follow through from 27. And they're going to argue this is a trading range to move up there. Johnny Cass, still always in short. I think back to trading range right now. Bulls are probably going to argue, if 28 is good, that it's always in long, but for me, I would still treat it as a trading range, and we're going to be high in that trading range. We've got no support layer here tested for the bulls as well. So where was the pullback? We've had one pullback, but that hasn't been tested. So if this is going to be low of the day, sell climax, we'll go up and pull back, and we'll do the same thing that happened on Thursday. Go up, sideways, breakout, sideways. And everyone's going to say, oh, look, it touched the 200, it's magical. Everyone was buying there. But if you go back in time to when those bars were printing here, 13, 14, 15, you were buying that 200, you'd be pretty stressed. And because the bears don't have a clear pause in this leg, it's difficult to find a place for them to put their stops. So it looks like we're retracing back up to the middle of the day. So you could be long here. I trade with a smaller size, looking for, pullback and then some kind of this support layer to hold. But the traders that took 18, low probability trade that worked out, they're going to have their 2-to-1 target somewhere up here. So I'm going to expect some kind of profit taking. We've got 2 breakout points here. We broke through one, so I'd be surprised if we break through both strongly. So I've got an update as well. I've got, I think Dr. Brooks is logging on now. So I'll just wait for him to jump in and then I'll jump off. Got in 2 sessions today, twice as much Aussiness. So you've got consecutive bull bars above the moving average. But you haven't got any support layer that's really been tested here. So I think still better to treat it as a trading range. Oh, thanks, Ashlow. Yeah, really appreciate it. If anyone's got questions, yeah, please put them in the Discord. We're lucky. We've got quite a few traders on here who are happy to answer questions. And I think it's good. Everyone's got some slightly different styles, and the commonality is all using Al's techniques. So there might be some that suit your personality a little bit more. So this, because these were kind of clear places for bears to scale into shorts, I suspect we're going to go sideways a bit here. If we do go sideways to the moving average, the bulls will need another buy signal. I think Al will open the questions box as well at some point in the session. You can always just put it on the Discord. So consecutive bull bars, 28 got a small close above 27, good for bulls. Bears didn't get a good pullback here for a clear place to put their stop, and so they're trying to create a layer of support. So a couple of legs up, this could be one leg, one pause, 2. Because we broke back above the moving average here, I don't want to sell on the underside of this bull bar. So some bears who sold there sell higher. I think some might get out here. And what I'm trying to see is, does this resistance area turn into support or does it hold? I might get out here. And what I'm trying to see is, does this resistance area turn into support or does it hold? I think the argument for the bulls would be huge triangle going into the news for the rest of the week, maybe. But I think this needs a second piece. I think there's a lot of kind of being patient and waiting when you're trading. So if you're not currently in a trade, you're wondering, okay, if I'm long, where's my stop? What would I need to see to stay in? What would I need to see to add on? Even if you're not trading multiple contracts and scaling in and out, that idea I think is really helpful. For example, if you're here on Friday, if you're long and you see bull bars closing on your high, you think, well, great to be long and stay long. No consecutive bear bars far above the moving average. Versus over here, consecutive strong bear bars closing on their low and now below the moving average. So what's happening here and what's happening here is different, and therefore I think your trading style needs to change. So that was the breakout point from back here on the 5th of April. So some bulls buying there, perhaps, and then 20 points. That's exactly 20 points. That makes sense. And that's what I was trying to measure out before, so if I didn't just put it at the breakout point. So traders buying there and buying 20 points lower. So I suspect those bulls will get out. Other bulls looking to buy, get back up to the middle of the day, back up to yesterday's low to close that gap. A lot of inside bars here. Inside bar, inside bar, inside bar. So will this turn into a full trading range, or is this the start of a small pullback bull trend? Currently flat. Oh, I think Al's just jumped on. G'day, Al.
This is a microphone test. This is Al Brooks doing a microphone test. Good morning, everyone. This is Al Brooks, and I misread the time that I was supposed to start today. I saw on the sheet 11:30, and I assumed it was Pacific time, but it was East Coast time. So I'm here now. We got a lot of interesting things going on with the market right now. Obviously, we had a sell-off and then a collapse. And you can argue it's 3 legs down. We have 1 leg and then a collapse and then a 3rd leg, or you can say a parabolic wedge, this being the 1st leg, this being the 2nd leg, and that being the 3rd leg. And it's a second reversal up. We're probably going to a 50% retracement, and this is yesterday's low. We may get up to yesterday's low as well. Can we totally reverse the day? Probably not. The best the bulls probably can get is a test of the top of the most recent sell climax, which is here, which is around yesterday's close. Will they get there? I don't know. Right now, on the rally, we've had a pullback and then another pullback and then another pullback, a little wedge bull flag, and now another pullback. So we're getting pullbacks, but they're all small and brief. This is a small pullback bull trend. We're getting gaps. Look at the low of 32 and the high of 28. There's a space in between. And then here, we tried to get a reversal from a little bit of a wedge bear flag, 3 legs up, 1. Other computers will say that's 1, and then 2 and 3. We had a good sell signal bar, but a tight bull channel. And there were more traders with buy orders at the low of the bar than there were with stop orders below the low of the bar. And we had a body gap at this point. This low overlapped the breakout point here, but the bodies did not overlap. And then here, this close, the highest close in the breakout point, and we overlapped it. Did we overlap it? Yeah, this 41, the low of 41 was below the close of 33, so that closed the body gap. And that often means the bull trend has ended. However, we quickly resumed up. Now, 48, a bad buy signal bar, so probably sellers not far above. We have obvious magnets above, a 50% retracement, and then this. I want to say something about the open. This is a 3-minute chart. Let me turn it to a 5-minute. Okay, here we go. Sorry about that. Here you cannot see the 3 legs down. You can see tails. I had the 3-minute chart up because I was checking something on my other computer, but you can see the 3 legs down. Let me go back to the 5-minute chart. The one thing I wanted to point out here is yesterday was a trading range day and a small range, and today broke above yesterday's high, and we had a reversal bar, bar 1. Whenever you have a small range day, yesterday, and then today breaks above the high and gets a bear reversal bar, or breaks below the low and gets a bull reversal bar, there's probably a 50% chance you're going to get an outside day. And we did. We traded above yesterday's high, and then we broke below yesterday's low. We collapsed below yesterday's low and went a lot further down. Getting 3 legs up, 1 pullback, 2 pullback, 3, and we have a 50% retracement magnet. We have yesterday's low as a magnet, and then less likely the top of the sell climax, the 12 high, and yesterday's close and the open of the week. Right now, I think we're not going to get there. I think we'll probably get a reversal somewhere here, maybe right around yesterday's low, maybe a little bit below it, maybe a little bit above it. And then we'll test down to the most recent significant higher low, which is the 26 low. It's right before this buy climax. So even though right now we're in a small pullback bull trend, when you have this much selling, the chance of today reversing all of it is maybe 30%. That means 70% chance we're not going to get to yesterday's high. Obviously, if we keep going up and up and up, then it becomes maybe a 50% chance that we get above yesterday's high. And if we get up here, then probably 70% chance we get above yesterday's high. But right now, there's only a 30% chance that we're going to get there. Even though this is a small pullback bull trend, it's probably a bull leg and what's going to end up as a trading range. The bottom of the range might be here, the bottom of the most recent buy climax. It might be here. We tried to reverse down here, or it may be somewhere down here. We have a bad buy signal bar of 17. A lot of times when you have a bad buy signal bar, the market will come down and test that high later. I'm going to put a marker there because that will be a magnet for the rest of the day. We may not get there at all. This is a pretty good rally, but right now I think there's probably a 50-50 chance we're going to get down to the 17 high at some point today. What do you do here? We were outside up, we went below 30, above 30, and now we're trying to go back below it. Arguably, some computers will see this as a wedge. One leg up, pull back, break out, second leg up, pull back, third leg up. I think you're only shorting below 31 if you can use a wide stop. It's still a tight bull channel. We have magnets above. So that will reduce the chances of this being the start of a swing down. If you're long, you get out below 30. You could, but 27, 28 is a bull breakout. We have consecutive bull bars, both good-sized bodies, closing in the upper third or upper 20% or so. And then we had a pullback, 29, testing 22. So this might lead to a measured move up. Now, by the way, I have roofers outside, so upstairs. So you'll hear some banging and voices. So 29, there's a gap. The 27, there's a gap. It's the 29 low and the 22 high. And the measured move could be from here to the breakout point here and gets us up to around yesterday's close. I don't think that's where we're going to go. As I said, I think it's more likely we'll top out lower. So the other possibility is the measured move is a double bottom bull flag. We went down, we went up, we went down and tested that low. So measured move up there. Look where it takes us, exactly to the 50% retracement. So that's another reason to believe that the market is going there. And that makes it less good to be shorting below 30. So it's probably too early to short. 30 is a bad high one buy signal bar. We have a breakout to a new high in the bull trend and then a pullback, but the two pullback bars are bear bars. So you got a bad buy signal bar, reasons to expect a reversal not much above. So you'll start to get limit order bears selling. Why would the limit order bears be hesitant? Because of the gaps, the gap between the 19 low and the 17 high. And then here we have a gap. We broke 20 as a breakout. We broke it with 19. We tested it here. And then here's a breakout, 27, 28. And what did it break out of? It broke out of this. We tested it a little here. I suspect we're going to test it more here. So I think we're probably not going to go much higher. We may begin the pullback here. We may go a little bit higher and get and pull back. I think this gap is going to close, the gap between the 29 low and the 22 high. So traders will be shorting. They'll sell the 30 high, they'll sell the 28 high. But these are experienced traders. Beginners, to do that trade, you need wide stops and you have to be able to scale in. And that's not something beginners should do. Beginners should wait for a good sell signal bar, maybe 32, 35, 36, and preferably wait for a test of these two magnets. As I said, this magnet is a 50% retracement of the sell-off, but it's also a measured move up from this double bottom bull flag. So there are two reasons for the market to get there. Whenever you look at a chart and you say, it's really not all that clear, that tells you the market is probably in a trading range. That's your radar telling you that the market is in a trading range. Yeah, we're in a bull trend, and you could also argue we're still in a bear trend, but the confusion means that we're in a trading range. When the market's in a trading range, experienced traders will sell anything that looks bullish, and they'll take quick profits, they'll scalp. They'll buy anything that looks bearish. For example, they'll buy the close of 21. They'll buy below 24. They'll buy below 23, and they'll take quick profits. They bought the 30 low. I want to say something about that 30 low. Okay, the low is 52.34 even, and this high is 52.39 and a quarter. 21 ticks above. So what does that tell you? It tells you that some bears, it tells you some bulls bought the 30 low thinking it was a bad short. It had to go up 21 ticks for them to make 5 points. It went up exactly 21 ticks. So that tells you that the bulls are starting to they're starting to scalp. So they bought a pullback. They bought the 31 low with a limit order. It had to go up 21 ticks. It went exactly 21 ticks. So the bulls are starting to scalp instead of swing trade. And the bears, we know that they're selling. Some will sell the 30 low and sell more 5 points higher. And it had to go up 20 ticks and went up 21. So some bears sold the 30 low. Actually, they sold 1 tick below 30, and then they sold 5 points higher. And they were filled here. It's back down to that 30 low, and you have bears who are buying. The bears who, you have bears who are buying. The bears who sold the 30 low and sold more 5 points higher. They try to get out break even on their first sell, 1 tick below 30, and with a profit on their higher sell. It hit their original entry. 32 went exactly 1 tick below 30. Let me check. Yep. And now it's bouncing. So if you're a bear who sold, 1 tick below 30, it hit your limit order to exit break even and bouncing. So this little bounce in part is bears who are hoping to get out break even at the 30 low on their first entry and unable. Up here in the open, now bar 1, big bear bar closing near its low after a small day yesterday, reversing down from yesterday's high. You know the market's going to try to test yesterday's low. So it's a reasonable sell below 1. And I want to say something about that. The low of 1 is 67 and a bear. If you sold that and you wanted to sell more, 5 points higher, the size of a scalp higher, it had to go up 21 ticks. So, but it went up exactly 20 ticks right here. Okay, so that tells you the bears were being pretty aggressive. They're sold below 1. They placed a limit order to sell more 5 points higher. It has to go 1 tick beyond that, 21 ticks. It went up 20 ticks and sold off. So that tells you that there were a lot of bears with limit orders to sell 5 points above the low of 1, and that's bearish. If you know there are a whole bunch of bears trying to sell, it reached their limit order but did not go above it. It sold off. That tells you that some of the bears were so bearish that instead of trying to sell 20 ticks above their first sell, they sold 19 ticks. Okay, so this is possibly, we had 3 legs up here. 1, pause, bear bar. 2, pause, 3, and then try to reverse. And so the bears were hoping this was a bear flag, a wedge bear flag. And then we broke out, and we have 1 leg up, a pullback, 2 legs up, a pullback, and 32, 33 is the start of a 3rd leg up. And as I said, I think we're going to get at least to the 50% retracement and maybe to yesterday's low. There's something else about outside down days. Let me pull up my encyclopedia. Okay, find it. Outside down days. Okay. Here's yesterday's high. Here's yesterday's low. We went above yesterday's high, reversed down, and we broke below yesterday's low. So at this point, it's an outside down day. Yesterday's high, yesterday's low, outside down day. Yesterday's high, we broke above it. We held above it for a long time and started to reverse down, and we broke below it. And we broke far below it, and we ended up closing near the low of the day. Same thing, yesterday's high, yesterday's low, big sell up. Look for one particular thing. Yeah, this kind of a thing. Broke above yesterday's high, reversed down from above yesterday's high, and then broke below yesterday's low, and broke strongly below yesterday's low. Usually, if you break far below yesterday's low, you're not going to go back up to yesterday's high. Usually, here we just kept going down. A break far below yesterday's low increases the chances that today is going to close near its low. The reason I think today is not going to close near its low is, let me see if I can find an example. Yeah, kind of this. You know, we've had a big reversal up today, a lot of bars up. Kind of like this. Today's even stronger. Trying to find something similar to today. You can see I have a lot of upside down days. Here. Upside down, big rally, similar to today. And we did not go to a new low, did not go to a new high. I think this is what we're going to get. I think we're going to sell off for an hour or two. I don't know if it'll be below the most recent major high or low, or if it'll be just a tight range. But I think we're going to sell off soon. I think we probably have to go up higher. You can see it tested the top of the most recent sell climax. It tested around a 50% retracement. And then we have a wedge, 1, 2, 3. And then we just drifted down. Another upside down, very strong rally. Doesn't matter. If you have a lot of selling earlier in the day and you get a reversal, you're probably not going to go back up to the high. Here, basically sideways for the second half of the day, and up, but not all the way up to the high. Here, this is an even stronger rally than today, but it makes a point that if you have an upside down day and a pretty strong rally, you're probably not going to go to a new low. And if you do go to a new low, you're probably not going to go far below the old low. And you're probably not going to go, if the market sold off far for a lot of bars, you're probably not going to go above the high. So today, similar. We have a big sell-off and a big reversal. Big down, big up, big confusion, and it usually results in a trading range. And that's probably what we're going to get today. Big rally, another big rally, but sideways. So chances are, okay, so we broke above one of the magnets, or two magnets. We got the double bottom and the gap, and then measure move up, and then it's the 50% retracement. And now the bulls are trying to get above yesterday's low, and if they can, they'll then try to get to the top of the sell climax and up to yesterday's close and the open of the week. So there is a cluster of magnets up here. I don't think we're going to get there. I think we're going to go down first. Is there anything to sell right here? Well, you know, it's bad for the bears. The bears who sold one tick below 30, and they sold more 5 points higher, and they were able. And then it came down here, and it touched their original sell price, but did not go below it. So they were unable to get out break even. So that's bad for the bears. The limit order bears did not make 5 points. Even the bears who sold more 5 points higher, it hit their profit-taking limit order, but did not fill it. So that's a problem for the bears. So it reduces the chances that we're on the verge of a leg down. I don't think we're going to go much higher. I think we're going to go down. First target is the bottom of the most recent leg up. We have a breakout, a pullback here. So it's a breakout, pullback in our channel, 1, 2, 3. But the bears need a sell signal bar. Even if they get it, it's more likely that we'll bounce around here. Do I think we're going to come down here? I think at some point today we're going to come down here. Less likely here. I think we'll retrace about half of that, maybe come down here, the bottom of the most recent buy climax. Now, if you're long, what do? Let's say you get out of your longs below a bear bar closing near a slow of 30. Do you buy above 32? It's right below important magnets. A doji is a weak buy signal bar, and it's a third leg up, 1 pullback, 2 pullback, 3. So we have consecutive wedges, 1, and then breakout. We're probably not going to go much higher. So I would be flat right here. And the next trade I would look for is a short. Well, you'll probably have to wait for it to stop going up, start to go sideways for several bars, and then look to sell. And the sell might be good for 5 points, might be good for 10 points. I doubt that it's going to be good for 20 points. So I think this is enough of a rally to generate confusion, and confusion usually results in a trading range. Also, in the rally, we had bad follow through after 18, bad follow through after 20, bad follow through after 22. When you have good breakouts and bad follow through, that's bad. That's not what bulls want. And the market typically does not continue rallying for the rest of the day if you're getting bad follow through. And then we have a lot of bars with prominent tails. You know, bull bar here, a breakout, but a big tail. Tail here, big tail here, big tail there, doji bar here. So again, another sign of two-sided trading. You can see over here on the daily chart, we're getting near yesterday's low, that red line. Daily chart, I'm going to get rid of that line. The new channel is maybe there, no, here, no, maybe here. This happens all the time. As trends weaken, as they get older, they weaken, and pullbacks break below the bull trend line, the bottom of the channel, and you draw a new channel, and the new channel is flatter, not as vertical, so it's not as strong. And at some point, you'll decide that it's no longer in a bull channel, it's in a trading range. Do I still think we're coming down to this low? Yeah, I think this is a spike in channel, and you call it a breakout in channel. And the market ultimately breaks below the bottom of the channel 75% of the time and gets down near the start of the channel. Sometimes it'll form a higher low, sometimes it'll go below and form a lower low, and then bounce and go sideways. So this is probably a bull leg and what will become a trading range. This whole thing is a breakout. You can call it a spike, pullback channel. You can call it a breakout, pullback channel. But the channel is a weaker bull trend, and a weaker bull trend tends to become more weak as it goes on, and it evolves into a trading range. You can argue that we've been in a trading range now for a couple months. You know, it's been up, but a lot of sideways trading, and a lot of sideways trading here. Right now, the market's deciding if April 4th, this huge outside down day, is a spike down that will lead to a channel down. And, you know, even if it does not, even if we go higher, I think traders will be selling above. I've been selling above and scalping on the daily chart. And, you know, if we get a new high, I'll sell again and, you know, look for 50 points or 100 points going down. Because I think that, I've also said that I think the market is going to go sideways into the election. And I do. I do think that's okay. So this is a reasonable sell, all right? But if you sell it, you're selling in a tight bull channel and you're probably scalping. So what does that tell you? If you're selling in a tight bull channel, is this a swing short? No, it's a scalp short. And if it's a scalp short, can you exit above 33? Can you use a tight stop like that? No. So if you do sell below 34, you better be able to use like a 15-point stop because, you know, this is a tight bull channel, and the probability of a tight bull channel turning into a bear trend without first transitioning into a trading range is small. So if you're a bull, I would get out of longs below 34. If you're a bear, I think you can short, but I think you can only do it if you're going to use wide stops because you have to do something to increase your probability. Selling in a tight bull channel is low probability, and to scalp, you have to win 80 or 90% of the time. And the only way you can turn a low probability short into a high probability trade is by using wide stops and scaling in. And that's something most traders should not do. The reason why I say most traders should not scale in is because most traders, especially traders starting out, their account is small. And hang on a second. And if you have a small account, scaling in increases your risk, and your account can become a lot smaller very quickly. So if your account is big enough so that you're not risking more than 1 or 2% of your account by scaling in, then you can do it. But if you have a $5,000 account, even a $25,000 account, that's probably not big enough to be scaling in with E-minis. Micro E-minis, yeah, you could probably do it, but not with full-size E-minis. Not big enough to be scaling in with E-minis. Micro E-minis, yeah, you could probably do it, but not with full-size E-minis. I want to go back to the 4th. I was in Brazil last week. I was in Brazil last week. Maybe some of you were at the conference, and it was actually a really nice experience. I think there were 250 people there, and I talked, I took questions. Everybody wanted pictures and autographs, and just really, really nice people. Just everybody's smiling, everybody's friendly. Just it was a very good time. Laura and I had a great time. Felipe Arana was the host, and he's just a very nice person and very competent person. It was a very good experience. But I bring that up because when I was in Brazil, I did not trade. I was on an airplane during this, and I totally was unable to trade it, which is unfortunate because that was a lot of money to be made. The point I want to make about this is you have a double top, this high and is that high. The market sold off here. It's at that price again. It's trying to break above it. It failed. It sold off again. So it's the second leg up of a double top reversal. And most of the time when you get a double top, the second leg up is some kind of a wedge. But a third of the time, the second leg up is very bullish. This is an example. I don't know, 10 or 12 bar bull micro channel. Every low at or above the low of the prior bar. Many bars closing near their highs. Then bigger bars here on the breakout. Bigger bars late in a trend often is an exhaustive end of the trend. And if you get a breakout, here we broke to a new high. We also broke above this tight gold channel. And you get a bear bar with a decent sized body, a bear bar closing near its low. It's a sell. So you sell to get out of longs if you are long, and bears will sell here. Chances are we're going to get a second leg sideways to up after this many gold bars, and this was it. That was the second leg. It was sideways, not up. And at that point, more bears were willing to sell, and we just collapsed for the rest of the day. Let me go back to where we are today. Can you still be long here? I would not. I would be out of longs below 34. Below 30, I think you can hold long, but now we have 3 legs up, 28, 31, and 33. We have consecutive wedges, 1 and then 2. That increases the chances that we're not going to go much higher. Sometimes you can get 3 consecutive wedges, but I personally would not be long here. And if I were short, I would only do it if I was using a very wide stop. The bulls are trying to get back above yesterday's low, and they're trying to get back up to this cluster of resistance. Yesterday's close, the top of the sell climax, the open of the week. As you know, on the open, sometimes you can get a huge sell-off, and then the market channels up for the remainder of the day. But if the sell-off is this big and has this many bars and it's an outside down day, usually you're not going to get all the way back up to where the day started. And when you do get one of those climactic sell-offs on the open, and you get a reversal, usually the reversal is in a bull channel. Big sell-off and then a channel. We channeled up all day. we got exactly back to the high of the day. So we were outside down, and then we went back above yesterday's high, so it became outside up. Here, sold off for about 10 bars, and then in the remainder of the day, a small pullback bull trend. But when you get a big sell-off and you get a reversal and you get a new high, this high went slightly above that. Usually, you're not going to go far above the prior high. Big sell-off, very strong rally, back above the high of the day, and went a little bit higher. But again, big sell-off in the open, and then bull trend for the rest of the day. Big sell-off in the open, a midday reversal, and then bull trend the rest of the day. But today's sell-off is bigger and had more bars, so it makes it less likely that we'll go all the way up. It's more likely we're going to go up and then convert into a trading range. Big sell-off, reversal, and then this. Can this become a major reversal? It'd have to go sideways for a lot of bars, or we'd have to collapse. And neither one of those is likely. It's more likely that we're going to go down, test this area, maybe test this area, and we'll go down similar to this. We'll go down in a channel. The second sell signal, 34, 36, and the bulls are buying the market. Now, why would the bulls be buying when we have consecutive wedges and consecutive good sell signal bars? Because they want the market to go up to this next cluster of resistance, and if we go below 36, a lot of the bulls are going to give up and a lot of the bears will sell. So, but the sell probably will turn out to be a scalp. That's why I'm saying that if you take it, it's probably better to use a wide stop and scale in. Then put up the day session and 60-minute chart, and look what we have. All right, so for the bulls, they're hoping this reversal up is the start of a bull trend. They're hoping this is just a bear trap and a test of the buy signal bar, a bad buy signal bar, and they're hoping that we go up from here. So they're trying to trigger the buy. We have a 2-bar reversal, a bear bar and a bull bar closing near its high. So they're trying to go above the high of the last hour, which is above 33, and they view that as triggering a buy signal. So a 60-minute higher low major trend reversal, bear trend, and strong first reversal up, and now they want to get a higher low double bottom, and they're hoping to get a bull trend here. And the bears instead want the market just to go sideways here. 15-minute chart, same thing. We have a huge sell-off, a very strong rally, and then we have a double top. We broke below the neckline, and we sold off, but we have a very good buy signal bar. By the way, if you cannot trade the 5-minute chart profitably, you should give thought to trading the 15-minute chart, and look to buy a reversal up above a big bull bar closing near its high, and look to sell a big reversal down here, higher high double top, a bear bar closing near its low. And scalping on the 15-minute chart, I would scalp for 10 points, not 5 points. Bulls trying to trigger the 60-minute buy signal. They want this to be a bear trap, and they're hoping that will accelerate up and totally reverse this. Some bulls bought above 35. That person, I'm not going to be buying above bars up here, I think. But if you're selling, I think you need a wide stop because we have a whole bunch of magnets, not much higher. Yesterday's low, the top of the sell climax, the 60-minute moving average, the open of the week, yesterday's close. Less likely we'll get all the way up to yesterday's high. You can hear the roofers banging away. Bulls just triggered the 60-minute buy signal. Are we going to get another breakout? Oh, we have a magnet a little bit above. Will bears sell the 33 high and sell more higher? Some will, right? But you can only do it if you're going to use a wide stop. The bears have to be concerned that 37 did not go below 36. It's a credible sell signal, at least for a scalp. And the bulls, there were more traders buying the close of 36 than selling. So that's not good if you're a bear. At some point, if you're a bull and it keeps going up, you have to buy again. But when you have 3 legs up and you're getting bear bars, I think it's better to wait for a pullback, a couple legs sideways to down, and then a bull bar closing near its high, and then buy. So I would just let it go here. I would not buy up here. I suspect there'll be more traders selling the 33 high and yesterday's low, and selling the 50% retracement and this measured move. So I think there probably are more traders who are going to be selling here than buying. But we'll find out. Bulls are trying to get a strong breakout, or I think more likely start to pull back here or soon. On the daily chart, I've mentioned a couple times over the past month or so that I'm looking for the market to transition into a trading range and for it to test down. Now the most recent, the most important target is this low. But I also said that every reversal attempt when the market's in a tight bull channel is more likely going to fail to reverse. So here we got another reversal attempt. And this one is especially strong, April 4. So maybe there's a 50-50 chance that this is the start of sideways to down for a couple of months. But no matter when you're in a tight bull channel and you get reversals, chances are they're not going to be the end of the bull trend. Chances are you're going to go higher. And by the time you decide the bull trend has ended, the market usually has to go down pretty far. Here you go, wedge, 1, 2, 3, a bar similar to April 4th. And at some point, you believe it's going to go lower, but when? Maybe somewhere in here when we're starting to get big bear bars closing near the lows and bodies below the moving average. But usually the market has to go fairly far down before traders believe that you're going to get a couple legs down. Here we got 3 legs down. I want to say something else about this chart, or the weekly chart. Okay. The pandemic sell-off and a big rally, and then we tested the breakout point, the pandemic high, and reverse up. And then we had a bear channel, broke out a little bit, and then strong breakout here, and we pulled back. And rallied strongly, very strongly. Okay. So look at the date of this, October. So the bull trend began in October. We have a sell-off into October and a rally. Look at the date of this, October. We had a sell-off and a rally. What do I think we're going to get this year? I think we're going to get a sell-off into October. And do I think we're going to rally strongly to a new high? I do not. Usually, when the market does something, everyone starts, when people start to see patterns, hey, October sells off and it's a buy. It'll work for 1 time, 2 times, maybe 3 times. But the more times in a row that you get the same pattern, the less likely it's going to work because everyone front runs the pattern and then there's nobody left to buy at the time that you expect the rally to occur. So I do think we're probably going to sell off into October. Do I think the sell-off is going to begin in January? No, it has not begun in January. Do I think it's going to begin in July? I don't know. This is very strong. So it's possible that we just go sideways like this for 2 or 3 months and then sell off in the summer down to the fall, down to the October low. And then the bulls will try to rally. But I still think the market has seen most of its gain for the year. Sorry, the roofers are bright. I'm not at home right now. I'm at my daughter's houses in Los Angeles, and she's having a new roof put on today. So I do not think we're going to get a big sell-off into October and then a huge rally. Big sell-off into October and a huge rally. I do not think that's going to happen. I think we're probably going to get a sell-off into October, and it could start at any time. It could start late. It could start in August, like in 1987. There was a sell-off in August and then a rally, and then a sell-off into October. But I don't think I don't think we're going to get another huge rally from the October low. I think everybody's going to be kind of disappointed by the election, whether it's Biden or Trump or somebody else who wins. Why are we rallying like this? Usually in the rally, when you rally into an election, it's because traders are confident that nothing bad is going to happen. Trump is good for business. Biden is, you can't say he's bad for business. Look at what happened when he got elected. Since he's been president, market's gone way, way up. So I think what the market is saying is they're not worried that whoever the next president is going to be a problem, whether it's Biden or Trump or Newsom or somebody else. I do think Trump is going to be the candidate. Not entirely sure, maybe 80% sure. And Biden, I think it's 50-50 that he's going to be the candidate. I think it's a mistake. The Democrats are making a mistake running him. So I think I'm hoping that they come up with a better candidate later in the year. But huge rally since last October. Unsustainable. You can't go up like this forever. Eventually, you're going to get profit taking, and the market will test the breakout point, which is a high from 2 years ago here, and maybe that breakout point. I think this is the really important price. And I think we're going to get near it some point this year. And, for a couple of years, every time we broke above something, the market went back below the breakout point. We broke above this major high, back below it. Every time we went below something, the market reversed back above the breakout point. We went below that, above it. They broke below that, and then back above it, right? So limit order bulls have been able to make money on the way down, and limit order bears have been able to make money on the way up. That's trading range behavior. But if you get gaps like this low and that low, and the bears who sold here and sold more higher were unable to get out break even on their first sell over here, that is trend type of behavior. So when the pullback does not overlap the breakout point, that increases the chances that we're going to go higher. So I think the market is going to dip below that at some point this year. I think it's going to dip below this at some point this year, or at least get down near it. And if we get down near it, but not below it, and we start to reverse up strongly, then we could go quite a bit higher. However, if we dip below it, then it means that this entire rally probably is a bull leg in a trading range and not a resumption of the bull trend. Back to the daily chart. Weekly chart, a lot of bull bars. We had 6 consecutive bull bars, and then we get a bear bar last week. But a tight bull channel, so unlikely that we're going to go down into a bear trend. If we go down, it'll probably be a bear leg in a trading range. Monthly chart. Really strong breakout, but I think we have to test this breakout point. So it may go sideways for 3 or 4 months, and then in October come down here. But I think that's the really important price. Right now, that is around 4,800 or so. Where is it? Yeah, it's around 4,800. So, and we're at 5,200. So about a 10% correction. The bears who sold, I sold the 33 high. I'm only scalping out for 5 points if I get 5 points. There's some bears who sold the 34 low, and that's at 38.75. They tried to sell more, 5 points higher. That'd be 43.75 plus 1, so 44, and it went high enough up. So the bears who sold the 34 low had to go up here for them to be able to scale in 5 points higher. And you can see they buy back at that 34 low. That's why we're bouncing here. But it's a wedge. Different ways to look at it as a wedge. 1, 2, 3, breakout 1, 2, 3, and then a breakout above the wedge and a reversal. Can you buy above 40? I would not. I'm still short. Betting that we've begun a trading range. We may go a little bit higher, but I don't think we're going to go a lot higher before we have a couple hours of sideways down trading. Tight bull channel, probably a minor reversal. We're testing the most recent higher low. We may test down here, and maybe right now maybe 50-50 chance we'll get all the way down here. And what's the odds that we're going to get up here? Right now, I would say less than 50% that we'll get there. And maybe 30% we get all the way up to the high of the day. Now, is this a midday reversal? Bar 40 is the middle of the day. There are 81 bars in the day, and I have a little gold dot reminding me of the middle of the day, bar 40, 41, somewhere in there. It's a midday reversal, but we've already had one reversal up from 17. We rallied for a couple hours. I suspect that we're probably going to be sideways to down for a couple of hours. And it could be in a tight trading range. A trading range, sometimes you make a new high. But I think we've begun a couple hours of sideways to down trading. Why are we hesitating here? Well, different reasons. One is the bulls do not want the market to go down too far. And smart bulls know smart bears sold the 33 high, and it has to go 21 ticks below that for them to make 5 points. The bulls are trying to prevent that from happening, and they're trying to get a reversal up from the bottom of this trading range and from the moving average so that those bears will have to buy back their shorts. Okay, I just got filled for 5 points, so I'm out. But I think we've probably ended the rally. I want to show something else. It's fairly common to form a wedge and then get a breakout and then get another wedge. And usually you're going to get some kind of a correction from that. A wedge, a breakout, second wedge. So consecutive wedges, common thing. Here we got about 10 or 15 bars sideways to down, which is what I think we'll be doing here. We'll get some, if you're going to get two or more legs, you have to get some attempts to resume up. But I think for the next couple of hours, this is what we're going to be doing. Try to resume, fail, try to resume, fail. Here we tested the breakout point. Here's a breakout above that, and we tested it. A wedge top, tried to reverse, and then another wedge top, we get a bigger reversal. Wedge top, tried to reverse, failed, and then got another attempt at a wedge top. Wedge top, tight bull channel like today, and then a breakout and a second wedge top, and then a reversal. Now, I want to make a point about this here. Here we got a new high, but wedge, and then sideways to down for a couple of hours. So I want to make one point about this. Okay. Sometimes you'll have a small pullback bull trend that'll last all day. And in general, you got to be really, really careful about shorting in small pullback bull trends because they're constantly forming wedge tops and parabolic wedge tops, and you get small pullbacks and the bull trend resumes. You can see we're collapsing, right? Testing the breakout point, and maybe that low, maybe this high. So I am going to short again. I may wait for a bounce. Small pullback bull trend. They're always forming wedge tops. Wedge top, wedge top. Why is this not consecutive wedge tops? Well, here we never did anything bearish. We just a strong bull trend right from the open. And today, we had extremely strong selling earlier today. So yeah, small pullback bull trend, but probably not going to last. Probably either we'll get a resumption of the trend, so bear trend, rally, resumption of the trend, or a trading range. And trading ranges are always the most likely outcome for everything. So chances are 41 is the start of a trading range. It's a surprisingly big bear bar. I'm going to get rid of this measured move. We want that. There's the 50% retracement. I'll get rid of that also. And we broke far below the bull channel. Here we got a spike pullback channel. Market testing the bottom of the channel. We'll try to bounce. But this is strong enough down so that we're probably going to get a second leg down, which means the reversal up on 42 is probably not going to lead to a new high. So no matter what 42 does, we're probably going to get a second leg down, at least a second leg sideways to down after 41. So can you buy above 42, hoping that 41 is a bear trap and that the bull trend is resuming? I would not. Chances are we're going to get a second leg sideways to down. If 42 is not going to be a good buy, then there probably will be more traders with sell orders at and above 42 than with buy orders at and above 42. So I would not buy. If you're an experienced trader and you're comfortable betting against moves, for example, we're trying to reverse up, you can sell above 42, but better to wait to see what it does. Can you sell 5 points above the 41 close? Arguing a lot of traders will sell the 41 close, they'll sell more 5 points higher. I think we've begun a trading range, and in trading ranges, nothing is as clear as you want. You expect a lot of reversals. Anything that looks bearish, they buy. So you can see more traders bought the market on the close of 41, even though chances are we're going to get a couple legs sideways to down. But the bulls are hoping it's just a breakout test of 23, and that it's a bear trap, and that we're going to resume up. But I think it's not. I think we're going to drop below the 23 high, and we're going to come down to the next support down here, maybe all the way down to this bad buy signal bar. So I'm not willing to buy here. I think it's more likely that this is the start of at least an hour, maybe 2 hours of sideways to down movement. 15-minute chart. I'll put up a 15-minute. Here's the 60-minute chart. Remember I said that it's a 2-bar reversal. We went down and then we reversed up on the second bar. But I said it was not a very good buy signal. That I thought there might be more sellers than buyers above, and there were. I was one of the sellers. 15-minute chart. A very tight bull channel, 6 consecutive bull bars, 8-bar bull micro channel. It's a 50% retracement and a test of the moving average, but probably a minor reversal. So 8-bar bull micro channel, a bull bar for the sell signal bar, probably a minor reversal. Minor reversal means either a bull flag, and then we go higher, or a trading range. And I think trading range is more likely. Might be forming a big triangle. We have important data coming out this week. Check my other computer for the reports. So tomorrow we have core inflation coming out, CPI, and then FOMC minutes come out tomorrow as well. That can move the market. And Thursday we have the PPI, another inflation gauge. So with the Fed, let me go off on a sidetrack. I think overall Powell has been a horrible Fed chair. No one is going to say that while he's the Fed chair, but I think he was horrible. Here's the cash index monthly chart. And in here, President Trump was just saying horrible things about Powell all the time, saying you got to cut interest rates, make easy money. And Powell eventually went along with it. And to me, that was a sign of weakness. You want an independent Fed chair. You don't want someone who's scared of bad publicity or doesn't like being called names. Anyway, he folded. And then all through here, I kept saying, the guy's a fool. He's the worst Fed chair we've ever had. There's no reason to keep interest rates near zero. You're going to create a lot of inflation, and you're going too far in the wrong way. You're going to get a big reaction back. So all through here, I kept complaining. In fact, I wrote on my blog that I thought Powell was terrible, and that he was making a terrible mistake. I thought he was smart, raising interest rates here, but now he's talking about cutting interest rates 3 times this year, and that's stupid. To me, I'm an eye surgeon. I'm not an economist, but I have common sense, and I've seen a lot of Fed chairs since I started trading back in 1987, and Powell is the one that has caused me. I don't trust him. I trusted all the other people to be making good decisions, and I do not trust Powell. He's talking too much. He's saying too much, and then he's changing what he's saying. I think, obviously it's not hurting the market. The market has rallied. We've had a huge rally, so he's not hurting the market. But his talk about 3 interest rate cuts before the end of the year, I think that's just stupid. It's stupid. Look at the stock market. It's going way up. Why would you cut interest rates? Also, inflation is still high. Why would you cut interest rates? It doesn't make any sense. The reason why the Fed is talking about cutting interest rates is not that they think inflation is under control. That's not the reason. They're not saying, okay, we've managed the economy successfully and inflation is no longer a problem. We're going to cut interest rates. The reason why they want to cut interest rates is that when you have high interest rates, the effects last a long time. People have loans that last a year, 5 years, 10 years, 20 years, and the changes in interest rates, they don't happen immediately. And the Fed is concerned that what they've already done is going to impact the economy for 6 months or a year after they stop, after they begin to raise rates. So they're afraid that if they wait too long to cut rates, the economy may be on an unstoppable path to a recession. So that's why they're talking about cutting interest rates. They're not cutting interest rates because they think the economy is weak and it needs a boost. They're cutting interest rates because they're afraid that keeping the interest rates as high as they are much longer will cause much more damage than what they want to tolerate. So I don't know if that makes sense, but they're trying to avoid a recession. And if they wait until there is a recession to cut interest rates, then they obviously did not stop a recession. So what they're doing is anticipating when a recession might occur, and they're trying to cut rates 6 months or a year before that, and they want to try to prevent the recession. Okay, what did I say? I said that we're probably in our trading range, and when in a trading range, anything bullish, they sell, anything bearish, they buy. So the bulls, we had something bearish, 41, they bought it. We have something bullish, 43, probably it's sell. Can you buy above 43, betting that 41 is a bear trap? I would not. It's a big enough bear bar so that we'll probably get a couple legs sideways to down. Have we already had a couple legs sideways to down? Not on this chart. We went down and then up. You can see on 42 we went up and then down, and 43 we went down and up. So if you look at a smaller time frame chart, we have had a couple legs. I'll put up a 1 minute chart here. So 1 minute chart, we have had 2 legs down, 1 pullback, 2. The bulls are hoping to resume, but I think more likely this is not a resumption of the bull trend. I think this is a bear leg in what will become a trading range, and this is a bull leg in what will become a trading range. The top of the range could be a lower high, around 50% retracement where we are now. The top of the range could be above this high, but there probably will be sellers at and above the 37 high, because the bears who sold the 33 high made money. If we go above the 37 high, you'll get bears selling again. Now, I said we triggered a 60-minute buy signal over here. We have the 2-bar reversal, and we went above a bull bar closing near its high, plus a bull bar breaking out above a bear bar. So right now we're on a buy signal on the 60-minute chart, but not a good one. The bulls are trying to begin a rally on the 60-minute chart. There's a problem with the buy signal bar. It has a fairly prominent tail, but they want a good entry bar, and the current bar is the entry bar. They want it to be as bullish as possible. So they would like the current hour to have a bull body. They'd like it to have a big bull body. They'd like it to close near its high. They'd like it to close above the high of the past hour. If they do all of those things, then traders will see this as a credible 60-minute buy signal. But chances are they're not going to do all those things. So chances are we'll have a weak entry bar after a disappointing buy signal bar on the 60-minute chart. The bulls who bought the close of 41 made money. It had to go up 21 ticks from that close for them to make 20 ticks, and it did. So here we have a bear trend, 41. It's a big bear bar, so it's a bear trend. It could have been like this, right? Is bar 12 a bear trend? Sure, it's a bear trend, right? And the bear trend continued. A lot of times the bear trend will not continue. Is 18 a bull trend? Yeah. And it went up for another, 15 bars or so, 20 bars. This is a bear trend. And the bears are hoping we get a lower high and that it's a spike down, and then we get a channel down, which is what I think it's going to be. So I think this will be a bear breakout, a pullback, and then I think we'll channel down, maybe 3 legs down, 1 pullback, 2 pullback, 3, maybe down to here, maybe down to here over the next few hours. Bulls are hoping that this small pullback bull trend is going to continue up to here and up to there. But they need to do more to erase 41. Right now, 41 is the dominant feature, and it's the controlling factor. So the bulls need to break strongly above 41 and above 37 to make traders can believe that we're going to go up to that next cluster of resistance. At some point, we've got to buy again. And at some point, the bears have to decide that the market's going higher. Are we there yet? We have consecutive bull bars closing near their highs, both closing above the moving average, and the body of the second bar is completely above the moving average. That combination is very bullish. But there's one phrase that I did not use. Okay, that makes it less bullish. You want to see consecutive big bull bars. Here, we have consecutive big bear bars closing near their lows, both closing below the moving average. And the body of the second bear bar is completely below the moving average. All right. So you're probably going to get some kind of a measured move down at a minimum from the breakout of the first bar to the close of the second bar. So open of that bar to close of that bar. And you can see once we got there, the bears who sold took profits. They bought. Testing the top of the 41 sell climax high. Probably more sellers than buyers. 43, 44. The bodies are not very big. So I do not think they are enough to resume the bull trend. I think we're in a trading range. I think we're going to be in a trading range for at least another hour or so. And the range could be fairly tight. So this could be the top, this could be the bottom, and we could just go sideways in a very tight range. Okay, 12 minutes past 10, California time. 3 minutes remaining in the 15-minute bar. So if you're trading the 15-minute chart, you're hoping that this becomes a good buy signal bar, a high one buy signal bar. But for that to be the case, you want a big bull bar closing near its high, and you don't want it closing below the moving average. You want it to be closing at or above the moving average. So this is a credible buy signal bar if it closes at or above the moving average and near the high of the bar. The bulls know that, and they're going to try to get that to happen. I do not think that's going to happen. I think it's not going to be a good buy signal bar, and I think we're in a trading range. I think we're going to be in a trading range for at least another hour. The bulls are hoping that if it's a trading range, this remains the bottom of the range. I think it'll be lower. I think it'll be somewhere down here at some point in the next hour, hour and a half or so. 2 minutes remaining to the 15-minute bar. Can the bulls get bar 45 to close near its high so that the 15-minute bar closes near its high? I think probably not. Will the bears sell below 45? I said trading range. And trading range means not a swing. So if it's not a swing, it's a scalp. If you're scalping, you need high probability. And is it high probability buying above 44 or selling below 45? No, it's low probability. Yet it's not a swing. So if it's not a swing and the probability is low, you can only trade if you can do things that increase the probability. And the two things you can do are use wide stops and scale in. But most traders do not have big enough accounts to do that. So most traders are kind of stuck on the sideline here. What happens if 45 turns out to be a big bull bar closing near its high? Then we probably will break above yesterday's low and get up to the 60-minute moving average. 15 seconds remaining, and the bulls are hoping to get as good a buy signal bar as possible on the 15-minute chart. Is that good enough? We had 6 consecutive bull bars here. We have a strong reversal up. It's a big bull bar, but it did not close near the not close high enough up on the bar, and it closed below the moving average. So I would not buy above that bull bar. The 60-minute bar closes in 15 more minutes, and the bulls are trying to get as good a buy signal bar as they can get on the 60-minute chart. At minimum, they want no bear body, so they'll try to get the hour to close above the open of the hour. The hour opened with bar 37, bar 36, multiple of 12. So the hour opened right here. And the minimum the bulls need is for bar 48 to close above that line so that there will not be a bear body on the 60-minute chart. You know, as I said, I think we're going to be sideways to down for at least another hour or so, and that we may get 3 legs down. So this may be 1 pullback, 2 pullback, 3. For the markets in our trading range, a really good trader can buy at any point, use a wide stop, scale in, and make money. He can sell at any point, use a wide stop, scale in, and make money. So can you be long here? Yes. Can you be short here? Yes. Which is better, long or short? I think it's probably better to be, if you have to choose long or short, I would choose short. But I think the range here might be very tight. Since bar 29, we've been in a very tight range. A lot of times the market is in a trading range and you don't realize it. So this is what we've had for the past 20 bars. It's a trading range, and we're right in the middle of it. And trading ranges tend to spend most of the time in the middle third of the range. You know, traders are looking to buy near the bottom and below the bottom, and then looking to sell near the top and above the top. 10 more minutes left in the hour. The bulls are hoping that this is a resumption of the bull trend, and therefore 46 is a high 1 bull flag, but it's a bear bar, and it follows a second bear bar, and we're likely to get a second leg sideways to down after 41. So probably more sellers than buyers above 46. I would not buy the 46 high. Right now, what's taking place over the next 10 minutes is a fight over the appearance of the 60-minute bar. That red line is the open of the 60-minute bar, bar 37. And the minimum that the bulls want is no bear body. So they want bar 48 to close at or above that line. The minimum the bears want is at least a 1-tick bear body. They would like the bar to close near its low. The bulls would like that 60-minute bar to close near its high. Probably it'll close somewhere in the middle, not at the bottom, not at the top. Do you think it's paying attention to the appearance of the 60-minute bar? Of course it is. Look at all these bars. We're oscillating around the open of the hour. So for the bears, it's a lower high major trend reversal. So it's a bull trend, a bear breakout, a lower high, a second reversal, low 1, low 2, but a bad sell signal bar, 47. So can you sell it for a trend down? I would wait to see if we start to get bear bars closing near their lows. I think right now, and this is scalping mode, and only for traders who can use limit orders and wide stops and scale in. I think most traders should be flat right here. If I have a choice, long or short, I would be short and using wide stops and scaling in higher. But when the market's in the middle of a tight range like this, the best choice is usually to wait. You know, when you start out trading, you know, you see all these different patterns, and you know, nothing is perfect. If you look for a perfect wedge top or wedge bottom or double top or double bottom, you know, you're going to quickly discover that it's hard to find them, because that's not what markets typically do. They don't form perfect patterns. Even if you're looking for perfect looking buy or sell signal bars, they're really hard to find. You know, so if you're looking for a double top with a good sell signal bar, you know, the sell signal bars, when they're good, they're usually just that, good, not great. And here at the bottom, you know, you get a bad buy signal bar, right? What you do is you wait for a bull bar closing near its high, and then you buy. If your stop is too far below and your risk is too big, then you trade small. So, you know, you just have to live with things that are just not as good as you want. And the market's always somewhat balanced, and therefore there's always a good case for both the bulls and the bears. And that makes it, that reduces the chances that anything is going to become very, very clear. You just have to live with the uncertainty. Now, if you look back, let's say you're a beginner, you've been trading a couple months and you're still losing money, and then you look back at your past 20 trades, what you're going to discover is that you've lost money, but that you took a lot of really good trades, all right? And you knew, when you look at that, when you took them, you thought they were pretty good trades. But then you'll look and you'll see that most of the trades you took, there were actually problems with them. You know, you shorted below bear bars or you shorted below bull bars, or bear bars that had small bodies and big tails below, or you bought above a tiny bull bar or a bull doji, right? So, you know, you took bad trades. It's better to patiently wait for good trades and take them. But one of the difficulties is high probability trades usually have more risk. So if you waited to sell below 12 or 13, there's a very high probability you're going to make money if you can put a stop up here. If you buy above 18, very high probability you can make money if you put a stop down there. So you have to trade small. By small, I mean 20% of your normal volume. So if you normally trade 1 E-mini, small means 2 micro E-minis, and you can buy more if the market goes your way. Now, what I was saying is, well, when you look back at your trades, I'll put up a 5-minute chart here. You know, you'll find that on a day like this, right? You know, maybe you shorted below this for a tight bull channel. That's a bad trade. But here, you got a higher high double top, possible final flag, bear bar closing there slow. You shorted below that and you made money. You bought above this. I don't know if you made money, but if you bought above this, you probably made money. The point I'm trying to make, you know, if you sell below that, you know, here it's big enough for a scalp, but you know, I think what you're going to discover is if you look back on a chart at the actual trades that you took, and you see the ones where you won, and you see the ones where you lost, your winners were probably using good buy and sell signal bars and good contacts. You know, so if you made a sold below this, then that would be a loser. But if you sell below that, the probability is higher, and you were a winner. If you buy above that, a prominent tail just below the moving average, you were a loser. But if you bought above this, you probably made money. So, you know, one of the keys to becoming consistently profitable is being patient and only taking those good trades. You can look back at your past 20 trades and you can see which trades were good. And those are the ones you should be trying to take. And you can see that most of your trades, there was something wrong with most of those trades, most of your losers. And you know, you have to be patient and eliminate them. I know you can argue that, well, Al, if I do that, I'm only going to take 3 or 4 trades a day. Yeah, that's fine. If you're taking 3 or 4 trades a day and you're taking really good trades, you know, you're in a great position to make a living as a trader. You know, traders, you know, it's not like on television where they jump up and down and they're all excited or they're very mad. No, traders are boring people. Successful traders are boring people. And I'm a successful trader, and I'm a boring person. You know, I don't try to hit home runs. You know, one of the questions somebody asked me in Brazil was, Al, what was the most you ever made on a trade and what's the most you ever lost on a trade? I said, yeah, I never make too much. I never lose too much. You know, I'm not trying to hit home runs. I'm trying to hit singles. I want a high batting average. You know, I want to win regularly, consistently, and do it for a living. And you know, I don't want to load up and make a huge win, because if I do that, I'm going to get huge losses, and huge losses are upsetting, and I don't want that. You know, I just want consistency. And you don't have to be a great trader to make a living. You don't have to be super smart to make a living. You just have to be patient, pay attention to your emotions, and do reasonable things. It's as simple as that. And you know, just patiently wait for good signals. If stuff happens too quickly on the 5-minute chart, then trade the 15-minute chart, the 10-minute chart, the 30-minute chart, the 60-minute chart. Any of that is good. But just be patient. And if you miss a trade, don't worry. There's always going to be another trade. So, all right, I'm going to step aside. I think Brad is taking over now. I hope everybody has a good day. We're probably going to be sideways for at least another hour. Maybe we were down for 15 bars, up for 20 bars. So we'll probably be down for, or sideways to down for 15 or 20 bars. I think we're going to break below this double bottom. This might be a spike pullback channel. So 3 legs down. So 1, pull back 2, pull back 3. And it's a big enough reversal. So I doubt we're going to close. I doubt we're going to go below the low. Big enough sell-off. I doubt we're going to go above the high. So I think we'll probably finish the day somewhere in the middle third. And I think there's at least a 50-50 chance we're going to break below the double bottom and get down to this area at some point today. Okay, hope everybody has a good rest of the day.
Everybody, just give me a few more minutes here and I'll have my screen up and running. Middle of a tight trading range, as Al said, it's a breakout mode. Probability is pretty close to 50-50. So obviously, climactic sell-off and small pullback rally. This is probably going to end up being a minor reversal. And that's why Al was saying that we're probably going to test down lower. So what are your choices? Tight trading range. You can call it a triangle. Many ways to draw it, but it's basically a triangle. It's breakout mode. Probability is really close to 50-50. Whenever you have the moving average, whenever you're oscillating around the moving average back and forth, you know that the probability is fairly low. I think we'll probably get down to the 41 low. It was reasonable to sell down here, and if you sell and use a wide stop, chances are you're probably going to make money. Bulls want a second leg up after the rally, the 3-bar rally here. But overall, tight trading range. We may get up to the 9 low. That's obviously one target. 9 low, 78 low. That could be a target. 15-minute chart, tight bull channel, and the bulls want a second leg. Remember what I said, breakout mode. And this may be the start of the breakout. So it's a swing buy above 50, stop maybe below 50, taking a chance that we get the second leg. Low probability, but decent risk reward. You buy above it, stop below, and who knows? Maybe we get all the way up to the 12 high. And that's why you'll have some bulls buying above this bar. But triangle, low probability. What about the bears? Bears, I think it's reasonable to exit above 50 and wait and see if you have a decent bear bar. You can see we're a minute into the bar and we're not rushing quickly to the upside. And that's a reminder that we're in a tight trading range. Bulls trying to get a strong bull bar for the entry bar. It'd be ideal if 51 looks like 50. It's a big bull bar closing up here. It'd be better if 51's a big bull bar and 52's a big bull bar. But what do you notice about this current bar? If you bought above 51, bought above 50, right now you're actually below your entry price. And we're also 2 minutes into the bar. So bulls, you had some bulls buying above 50, hoping and taking a chance that the market would rally really quickly to the upside. And then the market started stalling. It started going up a little bit, pulling back, going up again, pulling back, going up, pulling back. And what that creates on a smaller time frame is a wedge. It's hard to see it, but we rallied, pulled back, rallied a little bit more, pulled back, rallied, and now we're reversing. So you can see how this bar did not actually fail in 10 seconds. The market tried to break above, the bulls couldn't do it. And after a minute, minute and a half, 2 minutes, you had more and more traders selling out of longs, betting that we're going to test back down. So obviously now you have trapped bulls. Looking good for the bears. So let's see how 51 closes. So what can you do here? You're in the middle of a tight trading range, and it's generally better to wait for bars to close on its low. And 51's rather big. That's a little bit problematic if you're a bear looking to sell. But the 51 is a big bar, especially if it closes on or near its low. You'll have more traders beginning to sell. Higher probability to wait and see what the breakout looks like. 51 outside down, but a tail below the bar. It's a trading range bar. And the reality is probably buyers below 51. But we failed to break out to the upside. And if tomorrow, we failed to break out to the upside, and that increases the chances that we could get a downside breakout. But again, this is a little bit of an expanding triangle. I'd rather wait and see what 52 looks like. 15-minute chart. Bears want a downside breakout and a test all the way down here. But strong enough rally, probably a minor reversal down. There's probably buyers somewhere down here. Maybe at a 50% pullback from the 17 low to the 37 high. Same problem that the bulls had on 50. You can see 51. We triggered the sell below the bar, and we're not going anywhere. There's obviously more buyers below 51 than sellers. And that is what happens when you're in a tight trading range. Bulls hopeful. This is a measuring gap, leads to an upside breakout. More importantly, tight trading range. And we're trying to make higher lows and higher highs, and we're trying to make lower highs and lower lows. Bears trying to get follow-through selling in the final minutes of the bar and make 52 close below 51. It'd be better if it could close somewhere down here. So the bigger 52 is, the better for the bears. Bears trying to get follow-through selling in the final few seconds of the bar. Good for the bears. Increase the odds. We're going to go a little bit lower. Not a good bar for the bears. Increases the chances that there's buyers down here rather than sellers. And that's why traders that sold below 51, they were disappointed by the entry bar 52. So you had bears who sold below 51, disappointed by 52. They were buying back their shorts. You also had bulls who were waiting to see what the follow-through would look like, and they bought the close. Not a great stop entry above 52, but tight trading range. And because of that, we're in the bottom third of a tight trading range. We could easily rally to the upper third of this tight trading range. And that's why traders bought the close. Are there more buyers or sellers above 52? Probably more sellers. But because it's in the middle of the range, we could easily go all the way up to the 50 high before the sellers come in. You had some bulls who would buy above 50, bar 50, and instead of getting out below 50, they'd use a wide stop. What's wide? Maybe 1 times the range of the signal bar or 2 times the range. So they'd buy above 50, they'd buy more below 50, or even buy more lower. Other bulls, they knew that bears would be disappointed who sold the close of 41. So some bears sell, they scale in. The bulls know that, and the bulls are buying down here, betting that there's disappointed bears who sold the 41 close. But again, tight trading range, not really that ideal for stop entries. Bears trying to prevent the bulls from closing above with the bull bar close on its high, and obviously trying to prevent the bulls from closing above 52. But again, tight trading range, not really a good area to be selling. 51 and 52 are probably strong enough for at least a small second leg down. But in general, selling at the bottom of a tight trading range is really not all that ideal of a thing to do. The risk reward's bad. If you're selling down here and you put a stop up here, that's bad risk reward. And therefore, you can't do that. You can take it for a swing, but even betting that the market's going to go all the way down here is fairly low probability. So what will traders do? It forces traders to have to use wider stops, selling here and selling more somewhere up here, betting on sideways trading. Not a good buy for the bulls, but not a good sell for the bears below 50, the prior bar 53. Probably buyers below, and will probably bounce. Now, when I say bounce, how far? Probably somewhere in the middle. So again, tight trading range, breakout, probability of a breakout up or down is close to 50-50. We still may have to get down to the 41 close. Reasonable for traders to sell it if they can use a wide stop. So we'll probably test it. Now, what happens if this bar starts to get bigger? You may have bears come in quickly and start selling. So everybody's waiting for the breakout. They know eventually we're going to get the breakout up or down. So there is the triangle. And they know we're either going to get a measured move up or measured move down. I think we're probably going to pull back. Low of 17, high of 37. There's the midpoint. That's a logical magnet. But you can see there's not a lot of desperate selling. Bears who sold at close of 41, disappointed 42. They had a chance to get out break even. So I am still fairly neutral. But it would not take much to get a downside breakout here. Be ready, this could sell off quickly. But again, better to wait to see a strong breakout. So bear bar closing on its low. However, you're right at the bottom of the range. Probability is close to 50-50. Some traders will take the sell below 54, especially if it goes a few ticks below it. Some traders will take the sell and they'll use a tight stop, maybe a stop one tick above 54, taking a chance that will plunge to the downside. And if we don't break out quickly, they'll close the trade. So it's kind of like bar 50. Buy above it. If it doesn't race to the upside quickly, or if it races and starts to stall and pull back, traders exit. So the bigger this bar becomes, without pulling back all that much, the more traders will sell. This is not yet enough. You have bulls buying the 54 low, buying the 41 low. They're trying to get 55 to reverse up and be a bull bar. So bottom of a tight trading range, not really an ideal area to be selling, but you will have some traders selling here, betting that this is the start of a downside breakout. We're 1 minute into the bar, and if you sold below 54, your entry price is 32.25, and the market has gone down to 30.5. So it has not gone down enough to make 2 points. It's gone down enough to make 1 point, but the size of this bar alone is almost 4 points. And if you're selling below 54, you're not selling for a 1 point scalp. You're trying to get an early entry to catch the downside breakout and the test down to the 27 low or the midpoint from the low of 17 to the high of 36. So the bigger this bar gets, the greater the probability that we're going to get the swing to the downside. You can see on the 15-minute chart, we're starting to collect bear bars. Okay, looks like the Bears are probably going to win, so it's looking better for the Bears. It would still higher probability to wait and see how this bar closes. It would still higher probability to wait and see how this bar closes. We could still reverse up on 55 and be a strong bull bar. So there's no rush to wait for the bar to close. The fight is over trapped limit order bulls. Bulls buying the 54 low, scaling in, buying the 41 low and scaling in. Those bulls are trying to get out of their losing position. They probably will. Whenever this happens, you always have to be concerned about the downside breakout becoming successful. In general, tight trading range, probability is close to 50-50 that you get the measured move up or down. Now you do have trapped bears down here. They sell and scale in, and you'll have bears buying back shorts all the way down. So that actually lowers the probability that we're going to get all the way down to the 17 low. But at 55 is a big bear bar. If 55 closes on its low, that will increase the chances that traders start selling. About a minute left in the bar. You can see how we haven't pulled back too much. It's pulled back 50%, but it's not pulling back to the 55 low. I want to see if it's actually reached the 51 low. Okay, now it just reached it. So it's allowing limit order bulls to make money, or at least avoid a loss. Bulls buy the 41 low, they buy more lower, they're getting out around break even. That's a problem. If you sold below 54 in the final 30 seconds of the bar, it's starting to reverse up. That is not what you want to see if you're a bear betting on a downside breakout. You don't want to see the bar reverse and completely go from a bear bar closing on it near its low to a bull bar. That is a problem. I think bears get out above 55. The bears are hopeful that 55 is a pullback from the 54 bear breakout. However, let me back up. The bears are hopeful that this current bar is a pullback from the prior bar's breakout. But my issue with that, 3 pushes down, and we tried to break below 42 and reversing up. Plus, this whole thing's probably a trading range, and that increases the risk that we may end up getting all the way back up here. So bears, I think it's reasonable to get out above 55. If I'm an always-in trader, I would get out above 55. Too much risk that we're going to test higher. Now, what is higher? We could test up to the 53 high. We could test all the way up to the 52 high. It was reasonable to reach the 52 high right here. It's reasonable to buy above it. It's not a great bar to buy, but if you buy above 52, and this is what Al talks about with trade management, it's not really ideal to buy above 52 and put a stop down here. But if you buy 52 and you buy more at the 41 low using a wide stop, there's probably an 80% chance you can avoid a loss and a 60% chance that you can get out break even at your original entry. That makes me think we're probably going to get near the 50 high. So you'll have some traders buying down here, taking a chance that we test up to the 50 high. Bears trying to get the pullback. They're hopeful that 56 is a breakout pullback sell and a low one. But it's a low one right at the bottom of a tight trading range. And that will reduce the probability of traders selling here. It still could succeed, but at the moment, I think we're probably going to end up continuing to go sideways. I am long, and I have a target at the 50 high, or a few ticks below it, taking a chance that we at least test near it. If we start to stall, I'll reduce my position or exit the trade. I just realized I was on mute. Let me back up. I said I was long a few minutes ago, and have a target at the 50 high, taking a chance that we get up there. If we start to stall in here, I'll reduce my position or exit. Now, back to what I was saying. If you're a bear, it's easy to look at 54 and say, wow, of course that's a terrible sell. You sell below 54 and you get stopped out right now. What a dumb trade. It's actually not all that dumb of a trade. A lot of the traders selling below 54 are momentum traders. They sell below 54 and they're selling, taking a chance that 55 looks like 12. If you were watching 12 sold off quickly, and instead of pulling back, it went lower. If we go to a 1 minute chart, out of curiosity, I want to see it. That's the first hour close. Okay, there's 9:30, and you can see, so this is the close of the bar. First minute popped down, and then we went sideways. Can't be right. Okay, so it's this whole thing, 9:25 to 9:30, and then 9:31 sold off, went sideways, and then went lower. But either way, the point I'm making is here we sold off and we started stalling, and then the bar got a little bit bigger, and then it pulled back. It didn't go straight down quickly. Here's an example of what I'm talking about. When you sell below a bar like 1, and when you take any stop entry, you want the follow through to be really quick and aggressive. Look at a 1 minute chart. There's no pullbacks. And if there's no pullbacks as the bar is selling off, in other words, it's selling off and stair stepping down, it's not really pulling back all that much. What it does is it traps traders. It traps limit order traders and squeezes them out of the trade. So if you sold below 54 down here, and then 55 started to go down, and maybe it stopped, it pulled back 1 tick, went lower, pulled back 1 tick, went lower. What that would do is that would force more and more traders out of the trade. But if you remember what I said, bulls who bought the 54 low at about 3 minutes in, they were able to avoid a loss. They could buy, maybe they scaled in lower, they could get out break even, others could get out at the 54 low. And the more traders that become less trapped, or the more traders that are able to exit a losing position, if they're able to exit, then there's less traders selling out of longs and taking a loss. Opposite would be up here, bars 10 and 11. If you bought the low of 11 and 12 went down, you're going to be in a lot of trouble if you don't exit the trade, even by bar 12. If you're long on bar 12, that is obviously a terrible place to be long. And a lot of bulls are trapped they're trapped into a losing trade. And you have a lot of bears trapped out of a winning trade. So those bulls and bears are forced to sell aggressively at the market in order to get on the right side. So this is what I was talking about. We have basically 2 legs down. Leg 1, pull back, leg 2. We have a wedge, 48, 52, 55. And now we have a bull bar closing on its high, middle of the trading range. So that's in part why the market pulled back here. You also had limit order bears who sold the 55 high. They said, who cares, 2 legs down, nested within larger 2 legs down. But it's a bear bar. There's probably sellers above this bar, and traders sold above it. Some tried to get out around a 50% pullback. I say that they actually never reached 50%. Anyways, some traders sold, scaled in, and they were able to get out break even. So they sell 33.5. The high of this bar went to 36. So a bear sells, the high of 55 scales in 3 points higher, and they get out break even at their first entry. Are there more buyers or sellers below 57? 57 is a pullback, and it's basically a low 1. Probably buyers below 57, and we'll get at least a small second leg up. We don't have to test the 50 high, but it's reasonable for the market to get back up there. We tried to break below this range. We're probably going to try and do the opposite. And if the bulls repeatedly fail to break out to the upside, then we'll start to go sideways and try and reverse down. Now, why did we fail down here? Look at the daily chart. We had a big sell-off on last Thursday, and we pulled back for 2 days. and now we're testing near those lows. So there's a lot of trapped, disappointed bears in this area that started buying back shorts, and the bulls know that, so the bulls started doing the exact same thing, and that's what led to the bounce. Starting to stall in the tight trading range, no surprise. Middle of the tight trading range is not all that ideal of a place to do anything. I think it's still slightly more bullish than bearish. So the bulls, some bulls bought above 55, others bought above a bull bar like 56. But buying above 56 is buying in the middle of the tight trading range. You can take it for a swing, but really not ideal. And that's why a lot of traders bought the pullback 57. We had a rally 55 low, 56 high, and a lot of traders tried to buy close to a 50% pullback and the breakout point of 55. You can see we're getting vacuumed up to the high of bar 50. And the high of bar 50 is just one location out of several up here that are reasonable targets. You have other bulls that are hopeful this is the start of a second leg. Leg 1, complex pullback. Leg 2, and a test of the 78 low over here, or the high of bar 12. Now, what's the chances that we get up to the 78 low, or the high of 9, or the high of 12? We need to start getting stronger bull bars closing on their highs. Without it, probability is fairly low that we're going to get up there. Look at where we're at. High, new low. Lower high, lower low. Bears want another lower high and another lower low. We may form a wedge. 1, 2, maybe 3. But at the moment, middle of the trading range, and probability is not great to be doing anything. Well, there you go. 2 legs up in a tight trading range, trader sold it. What are the chances we get a bear breakout below 55? And we might. Whenever you're in a tight trading range, it's breakout mode. It's never clear. We're in a bear trend. We're also in a bull trend. You can see bad buy signal bar on the 15-minute chart. We just triggered it probably on the prior bar, or we triggered it 2 bars ago right here. So we triggered the buy above it, stalled, and now we're reversing down. Increases the risk that we test down to the 55 low again. What about selling below 59? Some traders will, but big signal bar in the middle of the tight trading range lowers the probability. But 50-50 chance, best to assume 50-50 for the bulls and the bears. You can see a lot of traders, as soon as 59 closed, they immediately bought it. Some bears will actually buy, trying to drive the market up to 50%, and then go short. They'll sell a 50% pullback at 59, trying to get better risk reward, and then a swing sell, and then a swing short. But this is not what you want to see. Whenever you're in a tight trading range, stop entries are just really, really bad. Here in a few, maybe about 15, 20 minutes, I'm going to talk about binary decisions and how a trader needs to structure their trading. What I mean by that is whenever you're trading, you've got to have a mental flow chart that's kind of spinning in your head. And if you listen to Al, you'll hear him, and he has one. They're mental binary decisions that are ingrained, that become ingrained, that tell him what to do. And the video course is really the example of that. The market's either in a trend or a trading range. So in every bar, you're asking yourself, is this a trend bar or a trading range bar? Then there's other pieces. if the market's in a trading range, is it tight or broad? So it's mentally going down a decision tree. Okay, we're in a trading range. Is it tight or broad? It's getting tight. Then automatically do nothing, wait for the breakout. When you're looking at maybe something more broad, pull up these slides. Move this out of the way. There we go. If you're in a trading range like this, look to buy in the bottom third, sell in the upper third. Look for wedge bottoms, look for wedge tops. Anyways, I'll talk more about that, but you have to have a way you really need to have a way to think on every bar in a certain manner. And what I mean by that is going through the same flow chart, the mental flow chart, every time the exact same way. You have to be very methodical and robust with what you're doing, or standardized with what you're doing. Otherwise, if you don't have the same thought process with every bar, what you're going to end up doing is becoming emotional. If step one, you look at the moving average and decide, are we always in long, always in short? Or maybe step one is just deciding what the market cycle is. And then step two is deciding always in short. And then step three is, do you have a buy signal or do you have a sell signal? And step four, maybe you have a few exceptions to buy and sell signals. If you forget one of those steps, what you're going to end up doing is you may end up, let me just find an example. You may end up looking at 37 and buying the close of the bar, forgetting to think about what's the market cycle, what's the leg count, what's the always in. So it's 59, bear bar closing on its low. And you can see some traders sold a pullback at 59, betting that we would get follow through selling on 60. We've got about 30 seconds left in the bar. The bigger 60 becomes, if 60 can close somewhere down here, that would increase the probability that we're going to go a little bit lower. Tight trading range, not yet high probability. High probability. So be ready. If 60 starts to become bigger, that could increase the risk that we're going to go lower, especially if 60 closes on its low, but not yet high probability to be selling. Bears trying for the downside breakout. So far, looking good. Bulls hopeful this creates a wedge. Bull, this creates a wedge. Traders are paying attention to see how much will 59 pull back. Excuse me, how much will 61 pull back? If 61 is a relatively big bear bar, that will increase the probability that we're going to go lower. So it's on a swing sell below 59. And those bears will add to their position if this breakout becomes stronger. You can see we're not racing to the downside. Very often, I'll take these sells, and if we start to stall for too long, I'll start reducing my position or exit and then wait for the breakout. This is not what I want to see. We're spending a lot of time deciding if we're going to break out rather than breaking out. And if you're spending a lot of time deciding on the breakout, you know you're in a trading range. Breakouts do not decide. Here, you know what's going lower. There's no question. You just sell anywhere and just hold on. Here, it's not yet clear. This is in the early stages of a breakout. So far, if you sold below 59, your entry price is 2.25. It's gone down enough for a 2-point scalp, and it's pulling back. That is probably not enough to satisfy bears. If your risk is this, you're not going to scalp out for 2 points. You're going to scalp out for 2 points if you think the trade is failing and it's going to reverse. You're not going to scalp out for 2 points if you think it's going to be successful. 3 consecutive bars good for the bears, but bodies getting smaller, bad for the bears, increases the probability that we're going to go sideways more than down. It's not yet clearly breaking out to the downside, and because of that, you can see what's happening. There's added risk that we get the reversal. More and more bears giving up increases the risk that we're going to test higher. What about buying at the market? Probably better to wait for a signal bar. Wait for a bar to close on its high. And even then, it's still in this trading range, so not yet high probability. Bears trying to get the downside breakout. Not yet high probability. Bears are doing a good job as far as getting 4 consecutive bear bars, but it's still within the trading range. What do bears do if 63 is a bull bar closing on its high? I think we'll have more bears begin to exit above the bar. You can see the momentum is dying for the bears. Bears are doing a good job as far as preventing bulls from getting bull bars, but where are the bear bodies? Daily chart, the bears trying to get a second entry, and we have 2 legs up for the euro versus the dollar, and that was the minimum expected, a second leg after the rally on April the 3rd. But at no surprise, there's sellers above April the 3rd, and now we're starting to go sideways. Probably going to pull back. What are the chances we get all the way down here? Or better yet, what are the chances we break all the way down here? I don't think we will. We'll probably go sideways. There's probably buyers somewhere in the middle to bottom third of this range. And there might be buyers below the low of the current bar. But you're right in the middle of the trading range, and that's not really an ideal area to do anything. I just realized I was on mute. If 64 is a bull bar, especially if it closes on or near its high, I think a lot of traders will exit above the bar. Bears starting to form a tight bear channel. And that's good for the bears. Lowers the probability that whatever reversal we get will be successful. But probably going to go more sideways and test up here fairly soon, unless we get a downside breakout. Good for the bears. Increased probability that we're going to go at least a little bit lower. But bottom of the trading range, we really need the bears really need a downside breakout here. And while they're doing a good job getting several bear bars in a row and preventing the bulls, right now the odds are we're probably going to pull back. I think bears get out of shorts above 65 if it closes on or near its high. Still going sideways. The fight is over the wedge. Is this a credible wedge bottom, or is it the start of a small pullback? Is it a tight channel that's going to get a downside breakout? It is tight, and that's a problem for the bulls. But you're getting buying pressure. And unless the bears get a clear downside breakout, the odds are we're going to go sideways here. Bears, they want a strong bear breakout with follow through and some kind of measured move. I think more likely we'll be sideways here. You can see on the 15-minute chart, bad buy signal bars lowers the probability for the bulls. Well, the bears tried to get the downside breakout 67, and it's not looking that great. What did the bears do above 67? I think some traders will get out, and if 68 is a bull bar closing on its high, that would be 3 or 4 legs down, and it would be ideal for traders to exit. The odds are the sell-off's a bull leg, a bear leg in a trading range, and because of that, we're probably going to rally. Targets, high of 65 or the high of 61. So the downside here is probably limited. Had I sold, I think I'd be flat at this point. This is not what you want to see for a bear breakout. It's kind of like this right here. And it's possible that it's 3 legs like this, 1, 2, 3, which means we may have to get all the way up to the high of bar 59, the prior major swing point of this channel. You could argue it's 65, but I think it's more minor. Bears trying to get follow through selling and lower prices. But probably a bear leg in a trading range. Obviously, if 68 closes far below 67, that will be different. And it would increase the probability of lower prices. But right now, probably buyers not far below. Is 68 a bear breakout below the wedge that's going to lead to lower prices? It might. 68 is a little bit of a surprise. Probably will get a second leg. But it really needs follow-through below 69. Otherwise, probably buyers not far below. But a problem for the bulls. We're getting a lot of bear bars and the channel down is tight. That will reduce the number of traders buying right here. You can see the breakout on the 15-minute chart. Probably always in short, but I think a lot of traders want to see 69 be another bear bar closing below 68. And this is why. Testing the 27 low. What do you do if 69 is a bull bar closing on its high, and let's say it closes at the midpoint of 68? I think it's reasonable for bears to exit. Here's the breakout point of 55. We broke below it, barely pulled back. Bulls obviously want to close above the breakout point. But this is a problem if you're a bear and you're short. Bad follow through after 3 legs down and what's likely to become the bottom of a trading range. There's probably more buyers down here than sellers. That's why I said I thought the bulls probably needed one more bar. This is really not what you want to see. And a lot of times when traders think that one side needs one more bar, what they end up doing is buying. They look at bear bar on 47. They say, yeah, it's good for the bears, but I don't know, maybe they need one more bar. I bet if I buy the close of this bar and put a stop, a measured move down, worst case, I get stopped out here. Or maybe I get out halfway down if 69 is a bear bar closing on below its midpoint, certainly below the prior bar. Best case, I catch the bottom of the move and we rally all the way to the 38 high, or excuse me, we rally all the way to the 59 high. That's pretty decent risk reward. Even if you let me do it like this. So here's the 5-minute chart. Here's a 5-minute chart. And some traders will buy the close of this bar and put a stop measure move down, taking a chance that we rally somewhere up here. So if they buy this close and they put a stop down here, and maybe they go for, at a minimum, 1 times the risk all the way up here, they've got a risk reward of 1. But the reality is, especially if they can scale in lower, the reality is they're probably going to exit before their stop gets hit. And if this trade's going to work, their actual risk may be much smaller than 1. So if we reverse up immediately, let's say we start to get a tight channel and then we get up here, what was the actual risk on the trade? You bought the close. I'm going to go back to this chart now. You bought the close of 68 and your actual risk was the low of 69. So your actual risk on this trade was tiny. And if we get all the way up to the 59 high, your risk reward on the trade is many times greater than 1. That's how a lot of traders think about scalping. And that's why it's really important to try and structure trades with 1-to-1 risk reward. And that can be difficult to do. That's why a lot of traders have trouble with trading. You know, if you listen to Al earlier, Al mentioned that most traders starting out, they have plenty of good trades to be profitable. However, they have too many bad trades. They have too many trades that are just losers. And what I mean by that is they're really big and dumb losers, like buying all the way up here and taking and scaling in all the way down and getting stopped out on 68. That's a really dumb area, for lack of words. And I say dumb, more or less just it's bad risk reward. This is a bad area to be buying back shorts. If you're down here, it's really better to have a little bit wider of a stop. So if I bought all the way up here and now the market's down here, this is not the area to sell out of longs. The area to sell out of longs is up here, maybe below 51 or below 59, not down here. The reason I bring that up is I'm going to turn off this screen. A lot of you have seen me bring up this worksheet several times, and I like to talk about it occasionally. This is a probability. Well, first, let me talk about the market. You can see we're racing up rather quickly, and that's because of what I just talked about. If this is 3 legs down, we'll probably test the 65 high at a minimum, and I think at least greater than 50% chance we get back to this 59 high. If I meant to say 65 high if I said 59. We'll probably at least get to the 65 high and 50-50 chance we get up to the 59 high right here. That's why it's important to understand leg counting. The greater if you can understand leg counting, it's going to give you, it'll help. That's where, let me go back to the spreadsheet and I'll talk about leg counting. So anyways, this is what I was talking about, and the reason why this is so important, everybody wants to scalp. They understand the logic of of scalping. You need a reward, Al says you need a reward twice your risk, and if you can do that, it's profitable, and that's better than the alternative of going for twice your risk. But here's the point I want to make. Both of these returns are the minimum to maybe make money and probably not lose money, but you're not going to make really anything. And the reason is when you factor in commission, slippage, the cost of technology, computers, internet, electricity, you got to have an office, you got to have all the little things. You got to buy a new laptop or a computer when the old one breaks, all sorts of things, data providers. And so this is not a working strategy. You really need to be at least somewhere up here in the 70%. For most traders, this is already difficult enough, let alone 70%. And the problem is most traders can't achieve this. And what they start doing is they start selling and trying to go for 1 times the risk. And what happens is they end up not getting filled at 1 times the risk. So what do? They naturally, and by the way, this is, if I'm not clear, it's always in long. We're probably going up here. And always in bears, they have to be flat. And that's the minimum. We could easily go up here. So traders want leg 1, pull back, leg 2. I am long, and this is reversing up faster than I anticipated. And I have a target 2 ticks below the 59 high at 36 even. General rule of thumb, whenever I'm targeting, I said 36, I meant 30. That was weird. I have a target 2 ticks below this at 38.75. Whenever I'm targeting some sort of resistance or support, I like to put as target 2 ticks below it. Because this was rallying rather quickly, sometimes it makes me question. I may end up taking half off and seeing what happens. We're late in the day, and this might be the attempt at a second leg. Low probability. I'll go back to that spreadsheet here in a second. But traders want this. Traders are hopeful we'll get this, and we might. All of that depends on the follow-through. One of my favorite trades is when you get a 3-bar micro channel crossing far above the moving average or below it. I call it an always in flip, and that's something I'll talk about in Orlando during a presentation. Kind of this same concept, but flipping below the moving average in a strong way, increased probability. We're going to go lower. I just took half off. Made a good example recently. Here's one breaking above the moving average, but late in the day. I think it's right here. Yeah, here it is. We had a wedge bottom, 1, 2, 3, and we tested the moving average, broke above it. That's usually good for a swing. That's one of my favorite trades. And that's kind of what happened over recently a few minutes ago. So bulls, they want 2 legs up. First target, tested the 78 low. Next target, tested the 12 high. Now, why did I take half off at the 59 high if I think we're going to go higher? Why wouldn't I hold on to the full position? Because risk gets big, and risk is a real thing, and you must respect risk. Whenever your risk starts to get big, you have to reduce your position, and you have to respect risk. I think that's one of the biggest problems everybody faces at some point, and that is, let me get a sip of something, just 1 second. One of the biggest problems I've had time and time again is not reducing risk. Risk never bothered me, which, is actually more dangerous than being risk averse. And I never had a fear of placing trades. And because of that, it made me very susceptible to taking dumb trades. But anyways, back to why I'm bringing this up. When the bars get big, you have to reduce your position. Otherwise, what you can't do is buy here, and now you're up. Let's say you bought at 27 even, and now you're up to, let's just say 37. You're up 10 points. Well, you have 10 points of additional risk if your stop is somewhere down here. You have to move your stop. And the reason for that is you've often heard some people talk about other people's money. It's never other people's money. So if I bought down here and now the market's up here, that's no different than being long than buying right now at this very second and putting a stop down here. So just because your stop's hypothetically a break even here, that does not mean you're breaking even on the trade. You're losing money on the trade. It's just you're not closing the position. So if you're long and you have break even, you have 10 points of open profit. If you lose those 10 points, that is still losing 10 points. So what do you do here? Obviously, it's buy the close, and that increases the probability we're going to go higher. So right now, buy the close, reasonable to expect some kind of measured move. Now, how do you learn to buy here? It reminds me of Thursday when we had that just really, I jokingly call it that scary sell-off. How do you learn to trade it? I think one of the best ways is to trade the SPY. The great thing about the SPY, it's the spider, it's the ETF of the S&P. And the great thing about it is you can trade 1 share, which would be 1/50th of a micro. Now, realistically, you're probably better off trading maybe 5 or 10 shares just so you're not bothered, just so you can actually, just to make at least a little bit of risk. But the point I'm making is, instead of having to buy 1 micro and have a really wide stop, buy 5 shares or 10 shares of the SPY. Put your stop in the right place, somewhere down here, and you can scale in lower. So that is what I highly recommend people do if they can. Obviously, you got to get over the pattern day trading rule, which that's for another conversation. But I think that's one of the dumbest rules on the planet, especially when it comes to trading. And I don't think it protects anybody. And I've heard Al talk about that as well, and he's pretty much said the same thing. The unfortunate thing with the pattern day trading rule is you get flagged if you're flagged as a day trader in your brokerage account with stocks, you got to have 25,000 in an account. And the unfortunate thing with that is if you want to be a day trader, then you're going to day trade an instrument, and they're trying to protect investors and keep investors trading a longer time horizon. But all it does is forces traders to trade futures markets and more markets with greater volatility and greater risk. But anyways, the point is, if you want to learn how to trade this, trade something like the SPY, buy 10 shares or 15 shares and just put a stop all the way down here and just hold. Just hold into the close and see what happens. Now, obviously, that varies. Same thing here. The bars are getting big. Just sell something at the market. And you can do the same thing with micros. If you normally trade 3 or 4 micros and you don't want to trade this, just trade 1 micro. Just buy something at the market, put a stop where it needs to be, and hold on to the trade. A lot of traders have a fear of entering because they're not willing to trade small enough. I've talked to several traders. They'll buy and they love scaling in to a position as it goes against them, but they hate buying and scaling in to a position that's going their way. And that's really unfortunate, because I think one of the best trades is breakouts. One second. I think one of the single-handed best trades you can learn is breakouts. And the best way to scale in is to learn how to scale into a winning trade. You can learn is breakouts. And the best way to scale in is to learn how to scale into a winning trade. So would I be upset by this if I was flat? No. Who cares if you're missing it? If you're uncomfortable with taking this trade, then don't take it. There's absolutely nothing wrong with being flat here. I'm going to check something on my other computer. I think we had a report. I remember hearing Al mention that there was a report earlier. We actually did not have a report. Oh, we had a report later this week. Oh, we have the Fed meeting. Never mind. Actually, it looks like it's just a Fed minutes, not a meeting. Anyways, bar 72, a little bit climactic, so may pull back here. But just look at 72. Is there any reason you would sell to close at 72? Of course not. So what do? Buy something. Buy 1 contract. Buy half a contract. But figure out a way to be in the market. As long as you're comfortable with the risk. The other reason why I think a lot of traders should trade the SPY if they can is one of the benefits to the SPY is you can learn how to keep a certain percentage position size risk. What do I mean by that? Well, Al always says traders should never risk more than 3% on any given trade. 3% is from the market price to your stop, not your entry price. That's total dollars at risk, which means if you're going to take a trade, you've got to trade much smaller than 3%. Maybe you have to trade 1%. Most traders should never risk more than 1%. Now, why am I saying that? Well, let's say I want to risk half a percent on every entry, and I never want to exceed more than 1.5%. That's really hard to do with micros when you're starting out, because 1% on, let's say, $10,000 is $100, which means that 0.5% is $50, and that's still rather tough, especially if you want to scale in. So if you're trading the SPY, one of the great benefits is you can trade really, really small and still be able to, let's say, only risk $20 a trade or $40 a trade. And the key is you can remove emotions. I know that trading the SPY, if you're trading 10 shares, it feels like you're taking a step backwards, but it's really not. The key with trading is to remove emotions. And that often means you have to trade smaller than what seems reasonable. You can see lots of traders were selling down here, and they scaled in, sold more lower, and look what happened. I forgot to mention this. Traders sell this close, they sell more here. Break even on the entire trade is down here. By the way, I opened the question box earlier, and I haven't looked at the questions yet. But if you want me to answer some of the questions, go ahead and ask it in the question box and go to webinar. What's the chances that this is a second leg trap and it's 2 legs up testing the high of bar 12? It might be, but in general, 2 legs up, you really don't want the second leg to be this strong. We have a really big bar on the 15-minute chart. Chances are the next 15 minutes is going to be disappointing. Climactic bar, the current 15 minutes, I suspect, will disappoint traders. Bad stop entry sell below 73, so probably more buyers below than sellers, and probably at least a second leg up. I don't know if we're going to go much higher, but I suspect we'll probably test near the high of 73. Why is that? Well, if you sell below 73 and you put a stop above 73, odds are you're probably going to lose money. And that makes me think that there's more buyers below the 73 low than sellers. What about exiting longs? There's nothing wrong with getting out of longs below 73. It's late in the day. But the reality is there's probably buyers below. 15-minute chart, disappointed bulls. Looks like we're going to get bad follow through. It might be a second leg trap. So far, disappointing. But the reality is we're probably going to pull back here. What about buying the close of 74? Not really all that easy or great of a trade. Testing the breakout point, 37. But I suspect we're probably going to get a lower high here. That's enough selling pressure to disappoint bulls. What are the chances we go straight down? I don't think we will. We'll probably get back to the 73 low at a minimum, but I don't know how much higher we're going to go now. This is enough to probably scare off bulls or prevent bulls. I say scare jokingly. 75 is probably enough. 74 is probably enough to convince bulls that the bears may get a second leg down, which means it's probably sellers above the 75 high. More and more traders giving up here. What about selling? Probably more buyers below, buyers in this area than sellers. So what do I mean by that? The problem with selling down here, yes, it's bad for the bulls, but the problem with it is This is a trading range more likely than the start of a trend. And if it's a trading range, you might be selling near the bottom of the range. So this is enough selling pressure to get a second leg. But if there's buyers down here and you're selling in this area, risk reward becomes a problem. You're selling here, your risk is somewhere up here. 1 times your risk is down here. It's probably better to do the opposite. And that's why not many traders are selling below the 74 low. Also, a lot of traders expect the market to test back to the 73 low. You can see we basically got a measured move down of 73, almost to the tick. So some bulls buy the 73 low. They put a stop twice the range down of the bar. Their stop somewhere down here. They add on around 1 times a measured move down. Why would they do that? Because there's bears. Bulls will do that. Now, why will bulls buy and add on a bar range down of 73? Because some of the bears who sold below 73 will take partial profits at 1 times the risk. 1 times the risk is basically a bar range down. So you'll have some limit order bulls buying. You have some bears buying back shorts in that area. And that's what causes the market to often test breakout points. Plus, if you just look at any chart, how many times do breakout points stay open? What I mean by that is, how many times on a chart, just look at any bar for stop entries, how often can you take a stop entry and move your stop to break even and it not get hit? You know, sure, if you bought down here, you actually would have gotten stopped out break even. You buy here, 16.25 is your entry. The low of this bar is, you buy at 16.25 is your entry. The low of this bar is actually 17 even. So here, this break even stop worked. But just about anywhere else, they closed. And the point I'm making is we're probably going to get, at a minimum, get back to 49 even, the low of 73. High one buy 75, but a 3-bar micro channel with a big bar on 74, that will reduce the number of traders willing to buy above 75. But high ones typically lead to pullbacks and then trend resumption. So the problem here, the problem I have with selling this high one is we may just get a brief pullback down to the bottom third of the 75 and then get trend resumption up. Plus, just ask yourself, on this chart, when you look at this chart, is the sell-off more surprising than the rally? Obviously, the rally 70, 71, and 72 is a pretty big surprise, and therefore probably going to get a second leg. 15-minute chart. Does this look like the start of a strong stop entry sell and 2 legs up, so a second leg trap? No. Now, if this 15-minute bar closes on its low somewhere down here, that would increase the probability that we're going to go lower. But at the moment, I suspect buyers below the prior bar, which means there's probably buyers below the 75 low. Someone asked if the close of yesterday is a magnet. Here's yesterday's close. And you can see we're right at it. Of course it's a magnet. Yesterday's close, high of bar 12. You can see the high of bar 12 is 56.75. The market went up 1 tick above the high of bar 12 and sold off. So the bears who sold anywhere over here during 71, as long as they didn't panic, they could have sold more at the 12 high and made money. This is the problem with, you see what I mean? Give me 1 second here. I had to get a sip of water. You see what I mean about traders selling the close of right here? It's not really a good area to sell out of longs. It's late in the day, so it makes sense. But the problem here is this is probably more likely to be the bottom of a trading range than the start of a bear trend. So if you sell down here, you're in essence selling at the bottom of the trading range. The worst thing you can do is be long and say, oh my gosh, 74 is a big bear bar. I got to go short immediately. I just need to sell at the market. Because the problem is, if you don't know how to manage the trade, you're going to look back and the market's going to be up here. And you're going to be kicking yourself, wishing that you would have held on to the trade. Look at all the traders who bought anywhere up here and scaled in. They're being relieved. And that's why I think it's so great if a trader can trade something like the SPY. And you can do the same thing in Forex markets. But if one can trade 10 shares and just put a stop somewhere down here and just add on lower, buy 10 shares, scale in 50 cents lower, which is the equivalent of 5 points in the E-mini. Try to scale in another 5 points if it gets filled. And then you have a lot more flexibility. Now, if you're long here and you scaled in, let's say once, 5 points lower or 50 cents lower in the SPY, the great thing is, worst case, just get out break even. You would actually get out break even on your first entry. You'd actually get out with a small profit on your first and a larger profit on your second. And what it can do is teach you not to panic. So if you trade really small, you'll look at the sell-off and go, yeah, it's just a pullback, whatever, I'll just scale in. Same thing over here. If you're buying, it's really great if you can trade small and trade something like the SPY, because you'll learn not to panic. It's easy to panic when the market's getting vacuumed down. One of the things you have to realize is that most breakouts are vacuum tested support and resistance. So when you see the market selling off quickly, it's searching for an average price or a fair price, a price that bulls will buy, and that more bulls will buy and overwhelm the bears. When the market's going up, it's searching for a price where bears will overwhelm buyers. Anyways, the point I'm making is this can look really scary during the time, but you have to realize it's probably a trading range. So if you're buying, let's say here, close of 18, if you sell out of longs right here, it's basically the same thing as selling to go short. You've often heard Al talk about how a skunk in the road is bound to get killed. That's kind of the same logic. This is a skunk stop. The early stop was getting out below 19 or above 20. The late stop is getting out somewhere below the moving average. This is not. And the later exit is getting out below the moving average. This is in the middle. And that's why a lot of traders, they will look for these kind of things. They'll look for a pullback to get overextended, and they'll look at it from the perspective of, okay, if I'm a bull, I'm really disappointed by the sell-off, but I'm not yet disappointed enough with 22. I'll buy the close of 22 or buy as it's going down, betting that it won't go much lower. Same thing with today. I mentioned the low of 68 right here. I said that 68 is a good bar for the bears, and it's a problem, but I don't know. I think the bears probably need one more bar. If 69 can be another big bear bar closing on its low, then I think we're always in short. And I mentioned how a lot of traders, if you go back to the recording during this bar, what I mentioned was some traders will do the opposite. They'll say, yeah, the bears need one more bar. I'm going to buy the close of this bar, bar 68, and I'm going to put a stop and measure move down. Worst case, I get out on the next bar if it closes down here somewhere, and I take a small loss. Actually, the worst case, I get stopped out somewhere down here. More realistically, maybe it goes down here, I take a small loss. Best case, maybe the market goes, and maybe my target initially is 1 times my risk, the high of bar 59. Now, let's say you took that trade. You had 1, 2, 3, maybe 4 times your risk, hypothetically. Obviously, traders will reduce their position on the way up, but you see the logic. The other reason why it's important to reduce your position when bars get big is you don't want to panic when you see this. When you see a deep pullback, don't panic. Could you imagine if you sold down here and you look back 6 bars later and the market's up here. And I say that because I've done that, far more times than I'm proud of. And the benefits of making mistakes is you learn. Target for the bears is the open of the day. It's a reasonable target. It's a logical target. But anyways, back to what I was saying with this is you have to learn. I think it's really important to understand always in trading in the major and minor reversals. In other words, where's the swing trade on the chart? Who is owning the market? And when you're in a trading range, you have to count legs. So sell off, probably going to get a second leg, probably going to get a third, maybe not the third leg, maybe that's the third leg. And often the third leg is subdivided into 2 or 3 smaller legs. So leg 1, leg 2, leg 3, subdivided into 2 small legs. Whenever you have 3 legs down in a trading range, don't sell. Whenever you have 3 legs up and what's likely to be a channel or a trading range, don't buy. Other than that, what you have to learn is swing trading in major and minor reversals. So when you see a strong rally like this, best case for the bears is a trading range. So don't sell somewhere down here. Trading ranges are always trying to get you to sell at the lowest point of the range and buy at the highest point of the range. It's easy to look at the rally like 18, 19, 20, and 21 and think to yourself, yeah, it's probably going to be a trading range. Therefore, there's no way this is going to be a trend. And it pulls back and then it breaks out with 27, 28 and you say, wait a minute, I thought this was a trading range. It's so easy to look at this in pain, missing the move, and finally on 37, throw your hands up and say, I've got to buy something. I'm going to buy right now at the market. And then you panic when you see 41. But look what happened to the traders who bought the 37 close. So they bought 37 close. Their entry price is 43.5, and the high of this bar is 42.75. So the market came within 3 ticks. Here, same thing. Anyways, the reason I'm bringing that up is this. When you see consecutive buy climaxes, you can call it consecutive wedge tops if you want. It led to a few legs sideways to down. But when you look at a 15-minute chart, this is what you're selling. And you know the first reversal down is probably going to fail. Now, it's really easy. This is one of the most probably frustrating things about trading ranges. It's just so easy. You see big bull bars, you buy it, and then you say, oh my gosh, it's breaking to the downside. I'm going to sell it. And then you look over here, and now you're getting a rally. Trading ranges are always forcing you to sell at the extremes. And that's generally the worst thing you could do. But you can see, bulls buy the close, disappointed. They try to get out break even at the original entry with profit on their scale ends. Bears, they sell down here, they scale in higher, they try to get out break even on their first entry, profit on their second. I think this breakout is strong enough. It makes me think we're probably going to go higher. Maybe we try and rally, get back up to 5,300, and then test back up here. Now, that's assuming the bulls keep the momentum going. But what if we test the high of 10 o'clock on the 9th today? So what if we just test the high of the day during the Globex hours and we go sideways for 15, 20 bars? Will the probability still be 60% that we're going to go higher? Of course not. It'll be lower. Okay, and by the way, open of the day. Open of the day, 71.75. High of this bar, 72 even. So no surprise. We tested up to the open and immediately pulled back. Daily chart, we came close to last Thursday's high. Last Thursday's bear breakout, April the 4th. Tested near it and we bounced, no surprise. Probably buyers around the moving average. We're entering a trading range, and if you've listened to Al, you've heard him talk about how a logical target is the low of the year, January 5th. and we'll probably get down there. I don't know if we'll get there by the end of the year, but full channels usually evolve into trading ranges, so we're probably going to start testing prior lower highs. 5-minute chart, first bar of the day, gapped up, broke above yesterday's high and sold off. Bar 1 closing on its low. It's a okay swing sell, higher probability to wait for follow through, but failed breakout of yesterday's high, so okay sell. And then bar 2 tested back to the open of the day. We have a bear bar on 1, so we have a sell below 1, buy above 2, but the bear bar is stronger than the bull bar, probably a second leg down likely, and at a minimum we'll probably get back to the 1 low. And you can see what happened. Instead of getting back to the 1 low and reversing, we broke far below 1. 3, 15-minute chart, bear bar closing on its low. So bar 3 is a bear bar closing on its low, but it's a 3-bar micro channel, and it's the close of the first 15-minute bar. And you can see right here, it is this bar right here. So probably going to go at least a little bit lower. Follow through on 4, probably sell to close, but middle of the trading range, pull back to be deep. Bear bar 5, but a small bar, disappointing, reduces the probability we're going to go a lot lower. 6, inside bar, probably going to go sideways. 7, an overlapping bar, probably more sideways to down. And then another bear bar on 8. Bears are owning the market in terms of time, but they're not really getting anywhere because we're at the bottom of the trading range. So we're still within the confines of this range. We may pull back, but we're in a micro channel. We had a 6-bar micro channel, and we've only had one bull bar out of the past 9 bars of the day. And that's a sign of decent selling pressure. Had to make a note for something. Then we had a bull bar on 9, probably sellers above. 10, doji. Strong enough sell-off will probably get at least a small second leg down, but probably buyers below 10. And then 11, an inside bar. So now we have a triangle, breakout mode. And then obviously we got a surprise breakout on 12. 12, strong enough breakout, probably going to get a measured move down on something. 13, follow through, still sell to close. Measure move, likely. So 1 measure move target. Open of 12, close of 13. Follow through on 14, still sell to close. And then 15, more sell to close. 3 big bear bars, measure move down, tail below 15, increase the probability we're going to pull back. 16, a doji bar. So we went down on 15, up to the 16 high, and then down again on 16. Bulls are hopeful that 17 is a bull bar, and it's a micro double bottom. It's possible that this is just a sell climax, sell vacuum test of support. And if you look on the daily chart, you'll know that 5,200, the round number, is near the low of this bar, which means we're getting close to a support level. The low of this bar was 94.25, and we're only about 16 points away. And that's an important magnet on the daily chart. Another doji, 18, probably buyers below the low 1, and we'll probably get a pullback, but probably trend resumption fairly soon. And then 18, strong enough surprise, probably going to go at least a little bit higher, but probably a trading range more likely than the start of a bearish bull trend. 19, pause, probably buyers below in another leg, which will happen on 20. 20, strong enough rally that we may get a second leg. However, there's room to the moving average above, so may go a little bit higher. And then 21, a bear bar. For the bears, 2 legs up, but a micro channel since 17, so probably buyers below. 22, bull breakout, possible parabolic wedge. 18, 20, 22, but a micro channel. And whenever you have a parabolic wedge, that's also a micro channel. So it's parabolic wedge top in a bull micro channel since 17. That will reduce the number of traders selling on a stop below 23. In 23, it's a bear bar, but it's closed at the midpoint of the bar rather than on its low. '24, we tested near the close of 22, sold off, closing below 23. Good for the bears, probably going to go at least a little bit lower, but tight bull channel, it's possible to rally up to 22. is the first leg in what will be a more complex second leg. 23, 3 consecutive bear bars, probably sellers above and a second leg down. And then 24, a doji. Now we're starting to stall. We have a wedge, 1, 2, 3. We may get a bull breakout of the wedge and test back to the 35 high. 27, bull bar, strong enough surprise, probably going to go a little bit higher. 28 follows through, probably by the close, and at least a little bit more to the upside, maybe a measured move from the low of 17 to the high of 23 or 24, projects up here. Doji on 29. Some bulls, they saw 27 as exhaustion, they sold to close, disappointed by the follow through on 28, and when 28 closed, they immediately bought back their shorts back at the 27 close. So that's why we tested back. Probably buyers below and another leg up. 39, bear bar. It's an inside bar, but probably buyers below. Small signal bar, lowers the probability. And then if I said 39, I meant 30. 31, bull bar, probably buyers below and at least a little bit more higher. And then a doji, 42, and then we drifted sideways to up. And every one of these pullbacks, because the rally is fairly tight, every bear bar is really a buy. And then we got 39. 39, we've had several attempts to break to the upside, and we're starting to get clear wedges, 1, 2, 3, and it's at resistance, the bottom of yesterday's low, bar 35. 39, okay for bulls to get out, but the reality is, even if we sell off all the way to the 29 low, it's probably going to be a minor reversal at best. 40, doji, bow to high 1, probably sellers above, and then 42, strong bear bar. What about selling the close of 42? I would not. You're selling the bottom of the channel, 29 low, and you're selling what could be the bottom of the trading range. So this is more of an area for traders to be selling. This is more of an area for traders to be buying back shorts than selling to go short, which means there's probably going to be bulls buying down here, betting on a bounce. And then 42, a bull bar, not bad follow through, probably buyers below, and at least a small second, probably buyers below. But 41 is also a surprise. There's probably sellers above, and in 41 we'll get another leg down. But you're in the trading range, and because of that, we may get all the way up to the 41 high before the bears get the second leg down. 43, bears sold the close of 41, disappointed 42, getting out break even. Bulls know that, so bulls are buying down here, and that's why we bounced. 44, we have 3 consecutive bull bars. However, top of the trading range, buying the close of 44 is like selling the close of 41. You're selling low in a trading range. Now you're buying high in a trading range. And even though it's 4 consecutive bull bars, 42, 43, even though it's 3 consecutive bull bars, 42, 43, 44, and 43 is closing on a tie, 43 is not all that great of a sell. You can take it for a swing, but the reality is we're probably going to go sideways, and the bulls buying up here are probably going to be disappointed. 45 sold off, found buyers, and then 46 broke below 45, probably buyers below 45, and at least a second leg up. And that's what happened on 47. 47, a little bit of a wedge, rallied on 42, sold off 43, rallied on 45, sold off 46. And now we're rallying again on 47, and it's testing near the high close of 37. Probably going to go sideways here. What about selling on a stop below 47? You can, but you're selling a body, a 1 or 2 tick body. I say that, let me see. The body of this bar is open is 38.75, close 38.25. So it's a 2 tick body with a big tail. That lowers the probability of this leading to a profitable stop entry. 48, disappointing entry bar for the bears who sold below 47, so probably going to go sideways. And then 49, another attempt at a second entry, but again, these are terrible bodies with overlapping bars, increases the odds that we're going to go more sideways. Bull bar on 50, you can take it for a swing, but channel, however, it's a triangle, 1, 2, 3, 1, 2, maybe 3, breakout mode, low probability, buy above. And you can see 51, it triggered the buy on 50, tried to rally, and then I can't remember, but in the final maybe 1 or 2 minutes, it's sold off. So if you bought above 50, you had at least 2 minutes to exit the trade around break even. And that's a warning that the bulls were not all that bullish. Go back to over here. If you remember on 69, when 69 closed, 70 started going up rather quickly. 71 went up very quickly after 70 closed. That's a sign of strong buying. This is not a sign of strong buying. 51 bear bar, but same problem as the bulls. We failed to get strong follow through selling. And then 54, I mentioned 54 was a reasonable sell below the bar, taking a chance that we break to the downside. And same thing as buying up here. If you sold below 54, you had at least 2 minutes to exit the trade before it reversed. And I believe, if I remember correctly, this bar sold off, and then in the final 30 or 40 seconds, it started to pull back once again. So in the first 2 minutes, it went down and up, debating what was going to happen. In the final maybe minute of the bar, it sold off. However, 30 seconds left in the close, it rallied back to the open. Always in traders get out above 54. It's 2 legs down. Bulls start buying. It retested the breakout point of 55 here. And then we started to try and rally. Bulls got 2 legs up, but then they got another bear bar 61, 59, and went outside down. 59, you can take it for a swing. Probably going to go sideways though, middle of a tight trading range, so breakout mode. And then we started to get several bear bars to the downside. And the bears, they tried to get the downside breakout with 67, and it looks like they're failing. However, then they tried to get one more bar, 68. And again, we had a wedge bottom, 1, 2, 3. And at that point, I thought the bears probably needed one more bar. You can see it's basically a measured move down of 43. So bears probably need one more bar, which means bulls will buy. And then 69 is a bull bar, failed breakout of the channel. First target for the bulls is the 65 high. I think the more important magnet is the 59 high, the most recent major lower high. And then we got a strong rally on 70, increased the probability we're going to go higher, and then 71, 72, strong rally, and a second leg up. And then we got a leg 1 pullback, leg 2. Now, why did it make sense to buy here? Because from a context standpoint, you had a strong reversal. And most reversals are not B bottoms, which means when you get a sell-off and then an immediate rally, usually you need a major trend reversal. So this bar 69 is basically a higher low major trend reversal. You had a big sell-off, a large minor reversal up to 38 and 37, and then you had a series, you had several legs down completing the retest. And you can also call it a double bottom, a failed breakout below the 27 low. So several reasons for the market to reverse here, which made a lot of sense for a trader to be buying down here. And then if you bought up here, I mentioned, so let me back up. You can buy it always in traders, always in bears, get out above 69. Bulls, they can buy the close, buy the close 72. But if you're buying 72, a reasonable magnet is the high of 12. High of 12 is 56.75, and no surprise, high of 73 is 57 even. So the market went 1 tick above the high of 12 and then pulled back. Also, no surprise, bears who sold the breakout point here. So here's a breakout point. Bears who sold it during this big bull bar, they made money. They sell here, they scale in, they made money. So bears making money right here. I mentioned that if you bought up here and scaled in, probably would make money. And instead of getting out break even on their first entry, profit on their second, you had a lot of traders moving their orders higher and adding to positions, and that's what led to 78 getting a strong breakout and rally. It's also a second leg up. Most breakouts get second legs. Leg 1, pullback, and you can see we almost got 2 legs up. a second leg up. Most breakouts get second legs. Leg one, pullback, and you can see we almost got 2 legs up. And then we went sideways in the close. By the way, and then Globex, you can see we're starting to pull back again, so that's disappointing. Okay, let me take a look at stop entries. For stop entries, always in traders, they sell below 1, they can sell below 3, they get out below 9. Unfortunately, they just have to sell either at the close of 12 or as 12 starts to go down. Sell the close here, sell the close here, so you can sell, be short anywhere. I think a lot of bears get out maybe 4 points above 14, 17 or 5 points above, or they get out on the close of 18. Minor reversal up. You'll have some bulls buying above 18, although not really. It's a minor reversal. Some bulls will buy. Other bulls will wait, but always in bears get out so bulls can buy. And then what about buying up here? I would not. You're buying right at the moving average, so better to buy a pullback or wait and see what the retest looks like. And then 27, 28, still not a great buy, but probably going to get a second leg. Still have traders buying any sort of pullback. And then no clear stop entries really in here. You can buy above 43, but same problem, buying in the middle of the trading range. Buying above 52, low probability buy, middle of a triangle, tight trading range, breakout mode. And the context doesn't make sense. It's not great. We had a sell-off and a trend line break, probably going to test back down to the bottom of the range. And then I thought the next stop entry, always in long. I think bears get out below 39. Bulls get out below 39. Bears can sell, but they have to get out above 43 because bulls will buy. And then the bulls, they get out below 47 or 51. Bears can start selling. And then 59, bears will sell, bulls exit. And then I think a lot of traders get out above a bull bar, but it never triggered on 65. And a lot of traders get out above 69. 69, I would certainly get out above the bar. And then bulls, obviously bulls, you had so many bulls buying the close at 69, they didn't even care that there was a tail on the bar. They were so eager to buy, they just hit buy the market because they were confident that the bar was going to trigger. And obviously it's always in long, buy the close, buy any pullback, another leg up. Limit orders, I thought probably buyers below 7, buyers below 6 and 7, but not really ideal. And then here, inside bar, not a good buy below, probably sellers above 9, but a really tough trade to take. And then I thought buyers below 16 for at least a scalp, probably buyers below 23. But parabolic wedge. And then probably sellers above 33 during 37. I thought buyers below 42, sellers above 46. And probably sellers above. And I thought buyers below 73, but the buyers may not come in until a measure moved down to 73, which was near the 75 low. Buy the close, sell the close. I thought it was sell the close on 4, 5, and 6. Sell the close 12, 13, 14, even sell the close 15, but getting parabolic and climactic. You can buy the close of 18 for a scalp, but not really ideal. Probably buy the close 28, breakout follow through. And 41, is it buy the close, sell the close? 41 is more of a buy the close than a sell the close. And same thing with 68. It's more of a buy the close than a sell the close. And then obviously 70, 71, 72, all buy the close bars. Even 74 is a buy the close bar. But that's a pretty tough trade to take, especially with it being late in the day. And then 78 buy the close. 79, I would not. You're right at the open of the day. Reasonable magnet. Okay, let me take a look at questions. Okay, question. How is 12 to 17? Sell the close. Okay. How is 12 through 15 different than last Thursday's sell to close? Yeah, so why is this right here different than this crazy day here where it was just relentless? There's a few things. One, if you look at it from the standpoint of, let's have a discussion real quick. Let's think about the markets. Markets are, we're looking at a 5-minute chart, but the reality is you have traders looking at daily charts, you have traders looking at weekly charts, and the more reasons there are for the market to sell off on higher time frames, the bigger the move can be. So like for instance on bar 1 or bar 2 on this day, bar 2 is strong enough for another leg down. However, we have this really big gap up. So everybody knows that, I say that, traders have the assumption that there's probably buyers at the moving average. Even if as long as we don't just sell off aggressively like this, there's probably buyers somewhere down here. Even this, as strong as this rally is, because of the bars to the left, it's probably sellers above. Now here, the difference was, on the daily chart, we were in a tight trading range and we started selling off quickly. I mentioned on the 60-minute chart during that day, at least I think I mentioned it. Actually, it was a 240, I think it was a 240-minute chart. I can't remember what bar it was, but anyways, the point is, what I said was this bar for some reason is bigger. Anyways, I can't remember, but I mentioned that somewhere over here, maybe a 30-minute chart. That is odd. Anyways, I'm just looking to see something. Weird. Actually, I think it was this chart. This was I mentioned that on the close of this bar, 9 o'clock, in the first 8 minutes of the next bar, we were already down a measured move of this range. So we sold off really, really quick. But why is it different? Look at the sell-off. We're breaking below, we're just collapsing below everything on the chart. And we were fairly high in the range on the daily chart, and that led to a strong sell-off. And you can see, traders selling all the way down, bear bar, another bar, another bar, big bear bar, bigger bar, all the way down. Now, why is that different than today? What made this different? Well, if you sold the close, let's say you put a stop above every bar and you trail on the way down, sell the close at 12, stop above 12, and then you hold, move your stop above 13, hold, stop above here, hold, stop above here. And then eventually you get out above a bull bar closing on its high. You would actually get out above 18. Look over here. Same logic. Trail a stop all the way down, get out above a bull bar. Maybe you get out above that bar, but price only went one tick above. And this bar is really not, it's the first overlapping bar of the entire sell-off. So it's really not a great buy above. And then we triggered, there's only two bars in this entire sell-off that went above the prior bar, here and right here. So if you do the math on that, the sell-off began up here, so here's 45. It ended down here at 47. That's 30 bars. So only 2 bars out of 30 actually broke out above the prior bar. That means 28 bars out of 30 that failed to break above the high of the prior bar, and that's a sign of strength. Now, how do you use that with today? Trail a stop and then exit above a bull bar. So the difference on Tuesday was always in bears, never really had a reason to get out. This bar here is following 2 sideways bars here with lots of overlap here in tails. I hope that answers your question. Okay, do you keep count of how many legs down this tight bear channel has gone from 55 to 65? Yeah. Look what happened. Leg 1, leg 2, leg 3. I'm always thinking of legs. Because very often, if you get a trading range and you get 3 legs down, especially if the third leg breaks below the channel and reverses, usually, occasionally, you can get a sharp reversal. So the reason why this context made a lot of sense to buy is it's a wedge bull flag, and it's a higher low major trend reversal. We had a strong rally, deep pullback, and we had several attempts to break to the downside, and traders got squeezed. All right, question, when there's sell to close, buy to close, do you keep adding to each sell to close, buy to close bar, or is there a risk reward problem with that concept? Well, yeah, I mean, plenty of traders will add to positions, add on the way down, add on the way up. In situations like this, I actually got lucky where I bought, and my position was already a little bit bigger than I'd want. And so when the market started to race up, I started reducing. I took half off here and just held for somewhere up here. And then I added on and got out somewhere around the close of this bar. But anyways, the biggest thing is making sure you don't have a set dollar limit. In other words, for a percentage limit. So I never want to risk more than, let's say, 1 to 1.5% on a given trade. That's a general rule for me. And if that's the case, then I've got to think about that. So if let's say I'm buying the low of 55 during this bar, and I never want to risk more than 1.5%. If I'm going to scale in lower, I've got to trade small enough initially so that my risk never exceeds 1.5%. Now, what that also means is this. I never want the market price to my stop to exceed or somewhere around 1.5%, which means if I buy above 70 and my stop's down here, and now the market's at 72, and my stop is still down here, I'm going to be probably risking almost 3% on the trade. So if I risk 0.5%, 1.5% here to here, now the market's up here, I'm risking far more than 3%. And that is what you have to pay attention to. That's why traders reduce their position. It's good practice too. Think like an institution. Institutions are never, if an institution, let's say you're a risk manager and you're trading a fund, you might be risking 25 basis points, and on any given trade, you cannot risk more than probably, 75 basis points on a trade. I doubt you're going to be risking 1% on a given trade. And because of that, and these are, if someone was trading, institutional volume on a 5-minute chart, they're going to trade really, really small. And if you were trading for an institution and all of a sudden you're long up here, you bought early and you're long up here and your stop's down here and you're risking, 4%, including open profit, you're going to have a risk manager tap you on the shoulder and tell you to reduce your position or close the trade. And that's the way you've got to treat it. Okay, question. When I see bar 51, here, I want to buy below rather than sell. May you explain again? I'm not sure what you're asking, but what I said here, I bought the close at 52 for a scalp, and the reason was I thought the follow through on 52 was bad for 51, and it's the bottom of a trading range. It's a little bit aggressive, but if the market starts to go down quickly, I'm going to exit. And the reason why traders are buying down here is because the market's probably going to go sideways. So I don't know if that's helpful or not. It's because the market's probably going to go sideways. So I don't know if that's helpful or not. Okay, let me take a look at Discord really quick, and if there's no questions there, I'm going to end the review. Here's an interesting one. It's a question for Tim, and Tim up in the Discord, but I will I'll make a comment on it, and we'll see what Tim says. But it's a question about what's your favorite swing trading book. They noticed quite a few on Amazon, and they found one by Andrew Aziz and Brian Pezim on Princey, quote-unquote, How to Swing Trade. And the comment says, Al does not have an official swing trading book. Just curious if you have any books or the ones you like. What I would say by that is Al is teaching someone how to read the market. And if you think about swing trading, Al teaches you how to swing trade. And the key is you have to learn how to count legs and read context. When it's in leg one, only look to buy and look to hold for a second leg. When the move gets climactic or it's in the second and third leg, only look to fade it. So like down here, 3 legs down, 1, 2, 3. There's no way I'm selling this unless it gets significantly stronger. When you get a sharp reversal like this after a wedge bottom at the bottom of a trading range, it's a reasonable buy betting on a second leg up. So there's several things, but the problem is swing trading is not as simple as you have to apply context to swing trading. And the better one can read context, the better they're going to be at swing trading. Okay, looks like that is it for questions. Okay, last question. Red G says, what should our mindsets be during bar 42 to 69? Leg in a trading range. So this is the problem, and I'll leave you something to ponder over the night going into tomorrow. So whenever you're long, let's say you buy up here. The problem with this rally is 2 things. One, nobody's going to put a stop at this. No one's going to buy here below 39 and put a stop at the 17 low, because 1 times the risk takes you up to the open of the day. It's terrible risk reward. So what are they going to do? They're going to, the only way they can do that is if they buy and scale in lower. The problem with that is if you don't exit somewhere in this area, the worst thing you can do is exit down here. So my mentality here was leg in a trading range. Leg 1, deep pullback, probably another leg down. We tried to break out on 55, we failed, and then we sold off here. Whenever you get 3 legs down in a trading range, usually, especially after a strong rally, I thought this was a higher low major trend reversal, and we got a strong rally. Now, what should your mindset be? It's not that simple of a question, but go back and listen to what I said with 42 all the way down to 69, and that will help you. Okay, so where do we go tomorrow? We're starting to form a trading range on the daily chart, or a tight trading range. We tried to get a second leg down and lots of buying. I think we're going to be sideways for a while. And we could easily probe up to the high of April the 4th before we go lower. At some point, I do think we'll be down here. I do think we're going to get back to 5,000 sometime this year. It just might take a while. Okay, thanks everyone for listening, and I will talk to everybody soon.